This next section is going to be a potpourri of investment ideas. You see, along with the major strategies like rolling stock and covered calls and option plays, there are a bunch of other strategies that you can implement and use all the time. For example, all the way from a company going public when it's doing an IPO or initial public offering, to possibly a company that's more seasoned, but it's having some hard times, and maybe it's getting ready to turn around. Other strategies like dividend capturing. This whole section is going to show you all of these different money multipliers that you can do individually or compound them and make a lot of money by implementing them with the other strategies that you've already learned. And this is one of the funnest ones for me to do. It's on page 39, section 7, called Money Multipliers. By the way, can I talk about that word multiplication and multiply for a minute? I don't want to turn this into Sunday school class. But by the way, can we go back on a few things? Remember we were talking about doing rolling stock? One of the strategies of doing stock, and well, heck, let me turn this into Sunday school class for a minute. A lot of you haven't been to church for a while. Maybe we ought to have it right here. Amen. How many of you believe that you could live your life? There's a bunch of revelations and inspirational things that have come down over hundreds and hundreds of years, have they not? How many think that you could live your life? Let's use the word Bible, okay? That's okay. It's my tape. If you bought it and you don't like it, too bad. But even the Old Testament, you know, how many of you believe that there's enough laws and rules in there concerning money that you could almost pattern and live your lives by that? Not almost, probably, you know, definitely, right? For example, remember I said remember that by buying and selling a little bit, you know, getting in and getting out, and don't sell at the high, right? And I said, what was the answer there, everyone? Don't get greedy, know your exit, right? There's an old Hebrew law, you know, it's in Leviticus, it's in Deuteronomy, that says, thou shalt not glean the field. Actually, it says, thou shalt not glean the vineyard. Why? What does that mean? What does it mean to glean? So you could go through the cornfield, you could go through the wheat field, the wine, you know, vineyard, right, the first time, and do what? The grape vineyard, and do what? Pick it, harvest it the first time, but you couldn't go back, and it says, even if there's a branch laying on the ground with grapes on it, you cannot go back and get it. Why? What did you have to leave some there for? The poor, the widows, and the fatherless is what it says. And one thing mentions foreigners. That was God's way of taking care of other people. See, if you're always trying to get every penny out of every deal, one of the reasons, for example, I think I was so successful in real estate is because I always sold houses below what they were worth. By the way, will you then have a steady market of people coming through your system? If you got a house that you bought for 85 and you're selling it for 95, but it's really worth 100 or 105, is 85 to 95 enough of a profit? So you got a great deal. Could you make it a good deal to someone else? All right, let's talk about another one. There's an old Hebrew law, an old Hebrew custom. It says, thou shalt not muzzle the ox. What does that mean? You know the ox that would go around the threshing floor, right? You were not allowed, as the owner of the ox, as the master of the ox, to muzzle the ox. Why not? So he can have some. Right? You know, it's like a beast of burden, right? And whether you take it from that down to employees or whatever, but people are allowed to eat a little. They're allowed to have a little bit of all that is there, right? It's like God's bounty for us. All right, let's talk about another one. Without getting too scriptural on you, it says multiply and replenish the earth. It doesn't say add and replenish the earth, right? Do you remember the story about Job? Job proved faithful, right? Everybody turned against him. Remember that story? Everybody, including his wife. Everybody murmured against him. Everybody called him names. Everybody told him how bad he was. They asked him to curse God. Remember that whole story? And when he proved faithful, what does it say? Doesn't say that. Doesn't say the amount. I've read this. It says it was multiplied unto him. The point I'm trying to make, everyone, is that it seems to me that there are some eternal principles that operate in multiplications. So I looked it up. I looked up in a Bible dictionary the word multiply and the word add. By the way, there's like 3 words multiply for every word add. And when you add, it says like this was added unto him, right? This ground here was added unto him. But usually the words are multiply. Multiply your flocks, multiply your lands, multiply everything. Well, isn't that what we're trying to do here? We're trying to take a little bit of money and have it do what? To prosper and multiply so that 2 becomes 4, 4 becomes what? 8, 8 becomes 16. Now, then you get exponential returns, do you not? And you just keep compounding and compounding and then using what is there to compound more, right? So I just take this for what it's worth, but we're talking about multiplying money, not adding to money. We're talking about using money as a money multiplier. So we have a lot of basic things, basic strategies to do. And the first one is to learn how to invest in startups. You know what? We probably should have started the Wall Street Workshop with this whole topic. give you a little timeline of what happens to a company. So come along with me now on page 39, and we're going to talk about startups, about investing in a company that is getting ready to go public. All right? So, Francis, you make widgets. You make really, really great widgets. All right? And Marianne is an investor. She's got some money. And Kevin is an investor, and he has some money. You want to entice them to invest in your company. Now, one of the ways you could do so, if you need to raise money, so here's Francis's widget company, and you need some money to now expand and grow. You know how to make them, you know how to market them, but you need some cash. So you go to these guys, to Marianne and to Kevin, and you say, I need some money. I want to borrow some money. So one way would be to borrow money from them. Do you guys like it or not? Maybe loan her some money, depending on the interest rate. What is she going to use for collateral? By the way, what do you think a lot of small companies use for collateral? They don't have any. I'll give you a second mortgage on my house. Can anybody think of anything in this world that would be more distasteful than taking somebody's house away from them, right, if they didn't pay you back the loan? Seriously, can you think of anything worse than that? So who would want to do that? And people do it all the time. People take people's houses away all the time. I don't want to get involved, right? So, but Kevin, Marianne may take a loan because she nodded yes. Kevin's going, no, I don't want to loan her any money. Kevin wants a piece of the action, right? So Marianne says, hey, if you're getting a piece of the action, how much? Kevin says, hey, I'll take, if you want $100,000 from me, and you want $100,000 from Marianne, you need $200,000 to do this. We'll invest in your company, or I'll invest in your company if I get a piece of that. So you give him, say, 1/10 of the company. 1/10 of this company, 10%, and I don't know how many shares that represents, but let's say that those shares are represented at 10 cents each. Okay, well, however many shares, it doesn't really matter for this example. But you're going to give him shares at 10 cents each. Are these shares marketable in this little private company between the three of them? Now, you know, Francis still owns 80%. Marianne now owns 10%, and Kevin owns 10%. Can they go out in the open market and say, hey, I own 100,000 shares, or I own 1,000,000 shares of stock in this company. Would you like to buy it? Yes, or could they do that? Yes, they could. Is there a ready market out there for them to buy, for them to sell their stock? What do you think, everyone? No way. Because if you want to invest in it, what would you have to believe in if you want to buy his stock, right? See, it's a private company, right? It's a closely held corporation. In this example, there's 3 people involved, and it's not worth anything. But these 2 venture capitalists, these vultures over here, right? And by the way, you can go to places like Santa Clara, right? Silicon Valley. You see a lot of venture capitalists down there? There are, everyone. All these computer startup companies, software companies. And by the way, find me a venture capitalist who has gone out of business. They don't go out of business. This is a very, very lucrative way of making money. Here's the point. They're willing to put up $100,000 and get stock at 10 cents. What they want to do, though, is a commitment from Francis that within the next 9 months, within the next year or 2, as this company grows to a certain level or gets their product ready to a certain degree, that company is going to go public and become a publicly traded entity. And at that point in time, Francis is going to take all the shares of stock, 5 million, let's say, 5 million shares of stock, and she's going to register it and have this become a public entity. Now, in this example, because it's going to go public, maybe Kevin doesn't own 10% anymore of the whole public company. Maybe he only owns 5%. But 5% of 2.5 million would be how much? 200, how many shares? 250,000, oh, 500,000 shares. 250,000 shares. And it's going to go public at $5 a share. What do you think? This happens all the time. What I just showed you up on the screen happens all the time. Companies will buy into a company, you know, a venture capitalist company will buy into a little private company with the hope that oh, by the way, Kevin is really good at this. He even knows how to round up the management team, right? The stockbrokers, the underwriters, right? And to put all together the team that's going to help Francis's company go public. Right? So let me walk you through this whole process here, because if you could latch onto a company like this that's getting ready to go public, one that's trying to raise money, you could make a lot of money. But by the way, is that a lot of money for Kevin right there? Now, there's going to be some restrictions on how fast he can sell his stock, but he just took 250,000 shares of stock that he originally bought at 5 or 10 cents, and now it's trading at $5 a share. So his $100,000 is now worth what? $2.5 million. Happens all the time, right? I mean, there's a Rockefeller venture capitalist group. There's all kinds of venture capitalists that just go around looking for some little computer software company, right? Some little company that has a new kind of radio program that will tie to computers, right? And by the way, how many public companies are there in America? 25,500 and a few more than that now. 25,500 publicly traded companies in this country. All right, so let's go through now this whole timeline. When a company first starts, its stock that it has, the stock that it has, is obviously private. Let me tell you what this means. Sometimes this stock is called founder stock. It is called insider stock. It is called ledger stock. Sometimes it's referred to as shelf stock, which is just stock that is held, you know, that they just own. Technically, everyone, it is called Rule 144 stock. Rule 144. In the Securities Act of 1933, that's where this comes from, is Rule 144. And I'll tell you what that means in just a minute. Well, it means this. It means it's restricted. So all of these types of stock have a headline called restricted. Now, when I say the word restricted, what does it mean? Restricted trading. They're restricted from trading. They cannot just go out on the open market unless it is registered, and then it becomes free trading. So let's go through this process. So Frances has the company. She starts issuing stock. If you have a little private corporation, is your stock restricted? Because you can't sell it to the general public until you do what? Until you register it. And then at that point in time, it becomes registered stock. So you take no matter what you call this stock, all these shares of stock now, all right, go along, and they're just totally restricted, but then at some point in time, they do a registration. Now, when a company does a registration, it has a couple of choices. To do a registration, it can exempt out because it can exempt some of the registration requirements because it's only taken on so many investors. Or it can exempt because it's only raising so much money. That's not what we're talking about. That's like a little limited partnership offering, like a Regulation D offering, where you're only taking on under 35 people and they're all worth over $500,000. Therefore, you don't have to do a full-blown registration. Now, if a company wants to do a full-blown registration, it is either what is called an S1 filing or an S18 filing. It has to get all of its paperwork ready for the SEC, do all its pro forma, get the prospectus ready, risk factors, and list everything, and get all this paperwork ready to go at a cost of somewhere between $10,000 and $150,000, depending on how big the company is, how many audits that it has to do, and it gets ready. If it wants to raise an unlimited amount of money, then it will do an S1 filing. If it wants to raise up to about $7.5 million, it can do an S18, and the requirements are not quite as severe as a full-blown registration. So a full-blown registration is what is called an S1 filing with the SEC. Now, once a company has done that and actually filed it, then it can go, now the step-by-step process, it can go to every state by state, and register the stock in that state so that state's residents can buy stock in the company. Do you think that that's a very extensive and expensive, lengthy process? What do you think? Very, very costly to do so. The other way to circumvent that, because most states, if the company will get in Moody's or in Standard & Poor's and get registered there, the states will just tie into that. They'll just buy into that, and the companies don't have to then register in each state. Okay, now once it has done so, once it registers either in Moody's or Standard & Poor's or gets a state-by-state registration, then it can start marketing its stock to the general public. We have a company right now here in the Northwest that is a new coffee company. It looked like they saw what's happening with Starbucks, you know, and they want to go. I hear advertisements on the radio right now saying, would you like to buy stock in our company? You know, call this number and we'll send you information. We're trying to raise money to kind of go into business here in the Northwest, and if it works, we're going to go nationwide, right? I've never heard an advertisement on a radio station trying to sell stock in a company. I mean, they're just blatantly trying to sell stock. Now, you have to call up a number, get a prospectus, you know, review everything and all that, but it's happening right now. All right, a company does a registration. Once it does the registration, then it crosses this line. All of this restricted stock now, once it is registered, then becomes free trading. So this is unregistered, and this is registered. And once a stock is registered, it is free trading. which means that there is a market now developing for that stock. Whether it's trading well, whether it goes up or down, is not the point right now. The point is that it is now registered. And I'll show you how it gets listed in just a minute. But I want to finish this up about this restricted trading. Kevin and Marianne really are restricted from trading this stock. Think about this, everyone. They have 5% of the shares in a company, which totals $2.5 million bucks. They only paid $100,000. Might they want to capitalize on some of their profits? So the very day that Francis gets all the stock registered, pays all those legal fees and all that and gets it registered, could these guys immediately sell a whole bunch of their stock? By the way, it's what is called go to the window. They go to the window. You understand what that means? Like go to the window and cash it in. What would happen to the value of the stock market or the stock value of that particular stock if Marianne wanted to dump 50,000 shares in one day? What would happen? The price everywhere could drop. So they're out at $5 a share or $10 a share. If she tries to sell too much, right? So here's the point. She can't do it. Marianne, you cannot do it. Now, there is possibly a way that in Francis's registration where she could get some of your stock to become free trading. But all of the insiders, all of the people that have Rule 144 stock are still restricted in their trading. The point is there's 2 points. One is that you have to wait, Marianne, 2 years before you can sell this stock. Okay? Now, it could be argued where the 2 years starts, but basically it's going to start when all this happens right now. Y'all understand why? They're not going to allow her to dump all of her stock on the marketplace, and she has to hold on to it for 2 years. Does that protect all the rest of investors, you know, that have just invested in this company at $5 a share, hoping that it's going to go to $8 or $9? Y'all see that? So it's a kind of a way of protecting us. Right. That's correct. And they're not going to allow you, as soon as the stock bumps up and goes non-restricted, to sell it all. And when it does come time to sell, Marianne and Kevin, at the end, and Francis, by the way, do you think Francis has restricted stock or not? Hers definitely is restricted, right? So the 2-year meter starts clicking. And by the way, even if you did find somebody, Marianne, okay, what's your first name?
Dean.
Dean. And he's a good friend of yours, and he wants to buy, say, 10,000 of your 100,000 shares or whatever, his 2 years starts all over again. The day you transfer the stock to him, the 2 years starts all over. Do y'all see that? There really is a restriction on this trading. And once it's time for you to sell, you can only sell so much in small increments. Now there's a little ratio there. You can sell like up to 20% of what was sold the previous quarter. All right? So if the previous quarter in any given day, so much was sold, then you can sell 5,000 or 10,000 shares here and there. Do y'all see that? So even when it does come time for her to sell, she's still restricted in her ability to sell very much of it at any one time. Again, is that a way of protecting all of us? Okay. Now, for example, I mentioned before that I have a publicly traded company. The stock that I own, and I own about 70% of the company, is restricted trading, right? By the way, I don't want to sell it anyway, but it is restricted trading. I will not be able to sell any of my stock for 2 years, from the 2 years of the time I got it, which is clicking away pretty fast, right? You see the point? You're restricted. Now, when a company then builds up some assets and wants to get trading, it has a couple of places where it can trade. All right, so here's kind of like the timeline, and that's not totally true because by doing that, by using the word timeline, a lot of companies follow this timeline, but it makes it sound like the later ones are where everybody wants to be, and that's not totally true. So I'm going to write a little bit small here because I need to get a lot on this one page. The first place that a company gets listed, if it's a small little company, doesn't have very much in assets, is what is called the pink sheets. And these really are pink sheets. Okay, I'll show you what, I wish I had one here. I was going to try to get one, but couldn't find one right away. But they're about this long, and it's a staple at the top. It's real thick, and they are actually pink in color. And anybody that subscribes to the pink sheet service gets them delivered to their office every morning. So all these stockbrokers have it. Everything in the pink sheets is listed in alphabetical order. Right? There's no ticker symbols in the pink sheets. However, so all new companies, small companies, right? NASDAQ companies, by the way, are also listed in the pink sheets. Now, they have NASDAQ as its own marketplace, but those companies are also listed in the pink sheets, and foreign companies. For example, I mentioned Nestle. You can't find Nestle on any of the exchanges. You go into the pink sheets, though, and look up Nestle. It's all alphabetical. Look up Nestle. You'll find that German company in the pink sheets. So foreign companies are also in the pink sheets. Okay? Now, once a company has so much net worth, for example, I'm going to put this down just a second. It's heading toward NASDAQ. In order to get on NASDAQ, you have to have X number of dollars of net worth. I'm going to put it up what this is, By the way, from yesterday to Monday, it's all changing. It changes all the time. NASDAQ is always under a lot of scrutiny to do more research into their companies. For example, I don't invest a lot of companies that are on the Toronto Exchange or on the Vancouver Exchange, right? Those exchanges have been very lax in their requirements on finding out about companies, right? So companies can have a negative net worth, right? All kinds of, by the way, you guys know as well as I do, us grown-ups in the world, are there a lot of different kind of accounting principles out there that are available? It's like, what's 2 and 2? Well, how much do you want it to be? Yeah. You know, it's that same thing. So if you've got this weird accounting stuff, can you make a bad company look good just with accounting gimmickry? Yes. And a lot of those companies have gone on some exchanges that I just don't trust their requirements. To get on NASDAQ, for example, you have to have at least $2 million in gross worth and at least $1 million in net worth. So in this example, you could have $1 million in liabilities and still qualify. You see that? Now, however, you could also have $12 million in net or gross worth, $11 million in liabilities, and do you still qualify? Because do you have $1 million of net worth? You see the point? So any one of these are fine, right? As long as you have $2 million in gross, $1 million in net, then you would qualify after you do all the other paperwork and all, you'd qualify to get on NASDAQ. But there's an interim place for companies to go, and that is what is called today the computer, well, I'm going to put up the word computer, but it's the bulletin board. So, when you hear about a bulletin board stock, right, you'll know what I'm talking about. This is an electronic stock. It has market makers. Usually companies on the bulletin board have 2 or 3 market makers. At the time of this taping, our company, Profit Financial, has 4 market makers, right? And these are guys that are buying and selling our stock, right? And we're on the computer bulletin board at this time. We are getting ready to go on NASDAQ. That's a lot of work because we've got to get all the requirements done, all kinds of filings done, all kinds of audits done, right? It's a lot of work to do that. And at the time of this taping, that's what we're doing right now, working with CPAs and getting all of our stuff done so that we can be trading on NASDAQ, which is the next level. So once a company grows in net worth and gets all the filing requirements done, then it can go on NASDAQ. Now, NASDAQ is spelled this way, N-A-S-D-A-Q. That stands for National Association of Securities Dealers Automated Quotation, right? In effect, electronic quotation. It's an electronic quotation system. That's what NASDAQ stands for. Now, this is not just some little marketplace. This NASDAQ is a place where a lot of companies are and want to be. As a matter of fact, I see just as much movement in companies that are on the New York. So let's go ahead and put these up here right now. Number 4 would be the major exchanges like New York and American Stock Exchange. These 2 exchanges. And there's a lot of companies that are listed on New York that want to be listed on NASDAQ. Electronically, worldwide, there's more trading on NASDAQ than all the rest of them. This is where all the activity is. So for example, where's Microsoft? One of the largest companies in the country now. Where's Microsoft? NASDAQ. Where's Apple Computer? NASDAQ. Where's Intel? NASDAQ. They're all on NASDAQ, right? This is where the activity is. This is where the hot stuff is. Apple Computer doesn't want to get listed on New York. They don't want to pay the price and all that. There's just not that big of a deal to be listed on New York. By the way, could it be prestigious for some companies? Boy, remember Harley Davidson? Harley Davidson, you know, went public a few years back, and they got listed on the New York Stock Exchange. That was a big deal. And they delivered a Harley to the president of the New York Stock Exchange, had him downstairs in that big marble corridor, you know, big old Harley sitting down there. That was a hot stuff for Harley. By the way, does Harley need some respectability in that case? Right? They're trying to be respectable because they got all these guys driving on these bikes and these little beanie hats on, you know, and they want a little bit of respectability, so they want to get on the New York Stock Exchange. All right. This is where a lot of the activity is. All right. This is where you're going to find a lot of your hot little growth companies, mini caps, companies and all that are down in here. All right. And probably about a third of my investing right now is New York. Once in a while, I find a stock on the American, but most of my investing here, a good half to 2/3, is right here on NASDAQ. I do a lot of my investing right there. All right. Now, you've taken your company public. Now, you want to do an actual offering. So it's not just going public. You want to actually invest in one of these startups. All right, let's talk about how to find them before we move on. How do you find these companies? How do you find them? You got some little company in your hometown that's getting ready to go public. How do you find out about it? By listening and watching. Can it be right on the 6 o'clock news at home? What do you think, everyone? This little company is getting ready to go public. What do you think? It's right there. Can it be in your local newspaper? Can it be in USA Today or the Wall Street Journal? What do you think, everyone? It is just an information thing. By the way, there are newsletters that come out with information about startup.
Wait, how do you determine what your stock comes on the market at?
How does Frances now determine what her stock is going to come to the market at? I tried to end that one without a preposition. It is basically between you and the underwriters. You take a value of the company, maybe a book value, projected earnings or whatever. Does it just really come to the people, the board of directors sitting there saying, we want to sell this stock? You're the person. You determine, what do you want to sell your stock for? You're going to sell off. See, now, he owned 10%, she owned 10%, and you own 80. Now, when you go to these guys and say, hey, we're going to sell off 45% to the public, you know, so you sell off 35%, you sell off 5% of yours, and you sell off 5% of yours. Y'all see that? And we're going to sell that to the public. And by the way, that stock, then you could raise some nice cash if that's part of the offering here, right? That's not restricted. You could actually sell your stock if it's part of the offering. The point is you guys determine that. Okay, by the way, once they determine it, let's say $10 a share, what happens the next day?
You need a buyer.
Yeah, you need a buyer. Then it comes down to supply and demand. All right, so let's move on. So you just determine that, what you're happy with. The next, number 2, everyone, is IPO. That stands for Initial Public Offering, an IPO. This is a company's first attempt at raising money. So Frances says, I not only want to raise money for myself, you know, to get some cash for myself to sell my stock, we need $30 million in our company, or $100 million, to expand overseas, or to develop new products, or whatever. So we need to raise some cash, and this is called an IPO. You can find IPOs, and by the way, you'll even see that in the Wall Street Journal, new IPO. There's IPO reports. You can, by the way, Investors Business Daily, in one of the back sections of Investors Business Daily, the newsletter, or the newspaper, you can find a whole IPO report in there. There's companies going public, companies doing all kinds of things, right? They're getting ready to go public and raise money. Now, what happens if a company raises $30 million, and 3 years later, it wants to raise another $40 million? What is that called, everyone? Is that called an IPO, or what is that called? Well, it's called a secondary offering, but sometimes they still use the word IPO. Is that an initial public offering for that batch of stock? What do you think, everyone? So you see how that works? It can still be called, but it rarely is called a secondary offering, then a tertiary offering. That's what they're called. Every time a company wants to raise more money. How do you get involved in these things? First of all, let's go back and answer how you find both of these, startups and IPOs. How do you find them? Newspapers. Talk to your stock. If you don't know, call your stockbrokers and say, I want to get involved in some IPOs. Okay? Yes?
Well, I own a chunk in a company that's about to go public in the next year or so.
Okay.
And now, when the lawyer came and talked to us, she said we had to have a quote-unquote quiet year where nothing could be said about the company so as to not have insider trading.
That's right.
And all of that. Now you're saying you can listen to the newspapers. As far as I know, this company is being
Well,
quiet.
first of all, what would you expect a lawyer to say?
Well, she's in charge of getting us public.
I know that, but so their concern is that you're not divulging information to somebody else about it, right? That's their concern. But by the way, can the company come out with an announcement that they're getting ready to go public? By the way, can the company even do kind of like a limited offering to certain people and try to raise more money? What do you think? If it does an offering, if it does a registration, it can do all kinds of things, right? And by the way, could it say in that offering to a limited number of people, we're trying to raise an extra $15 million for the sole purpose of going public? Can't guarantee it, but we're trying to go public. What do you think? You know, that's the purpose of raising more money, to get it publicly traded. Okay?
The other thing, we just had our annual stockholder meeting. They're trying to decide whether to do one more year of venture capital or the IPO.
Right?
The financial guy says the IPO market is quote-unquote soft, and that we'd have to do a 6-to-1 negative buy. Why? What makes an IPO market quote-unquote soft?
Because there's so many of them. The question is, what makes an IPO market soft? And the question is, if the answer to that question, I don't agree. The answer is that if there's a whole bunch of companies doing IPOs, can there be only a limited number of investors getting involved? I think it's exactly the opposite right now. And again, we're summer of 1995. Let me tell you what I see out there. 2-3 months ago, a company named General Magic was going to go public. $14 a share, right? Before the day was over, the stock was up to $30 a share in one day. They were 18 times oversubscribed. Tell me what that means. Say again, they're 18 times oversubscribed. All the people that want to get, see, little guys like me, you know, I want to get a couple thousand shares at $14 a share. Didn't stand a chance. Before my order was in, there were these big, huge pension funds, other money, they were all buying up this stock like crazy. I just saw a report on about the last 10 IPOs about 2 weeks ago. They just almost doubled in value, right? Almost all of them within a day or two of going out with the offering. right? Right now, I'm seeing exactly the opposite. If you've got a company that has a little bit of jazz and pizzazz to it, y'all see that? Now, if you got a woodworking company, or you're taking home Claire's Pottery Company, right? Has that got any excitement to it? So some lady's operating in her back bedroom making these incredible, great pottery plant holders, right? And she's going to go public. What do you think? Got any jazz to that one? No. But if you got a company that's high-tech and it's got some neat little toys that they have and some neat little, patents that it owns or copyrights or whatever, then it's got some excitement to it. You see the point? So if you've got some excitement, my answer is, if you're going to go public anyway, get public as soon as you can. Let the increase in value ride, just ride with it on up.
Once a company is oversubscribed, like you were saying, when does the little guy get in?
Let's do it. Okay, here we go. Not only, look down the bottom of page 39. You got a matter of timing here. Timing 1, timing 2. All right, let me tell you what I've seen. How many heard of Boston chicken before? Boston chicken, what did that come out, like $18, $19? What happened before the day was out? 47 bucks a share, right? Oh, man. Whew. What happened? 3 weeks later, where's the stock? $18, $19. All right? General Magic comes out at $14 a share. What happens? Up to like 30 bucks. Where was it 3 weeks later? $13 a share. So you got two choices. And let me tell you what I do. I've only gotten involved in a few of them because it's almost impossible to get involved in them. If you can get involved in the initial deal, like get in your offer, right, to buy the stock, and you get some, what I do is I get the stock and I wait for it to go up 60 or 70% and sell, right, usually by the end of the day. Okay, when they come out, they just run right up. Sometimes 2 or 3 days, and they run right up. If there's a lot of jazz and pizzazz to it again. By the way, let me tell you about another one. Tell you another way of finding them. Call up my stockbroker, and I want to buy a stock. And he tells me, I'm restricted from giving you, I'm restricted from the stock. Man, every time he says that, my heart goes pitter-patter. What is a stockbroker telling you when they say that they're restricted from trading, or they're restricted? Now, I can call them up and ask them information. If they get solicited information from me or a request for information, they can give it to me. But they cannot solicit me, right? Because their brokerage firm, a big New York, right, stock brokerage firm, has restricted their agents from peddling or pushing a certain stock. Usually what's going on? Yes, maybe it's going to go down the tubes, right, and they know something and they can't tell their clients about it. But usually it's a merger, right? It's a stock split. It's them raising more money, and that big brokerage firm is involved in the deal. By the way, could one company have several different brokerage firms involved in a new offering? What do you think? If you look at some of the stockbrokers' pages where it says we're raising $250 million, and there may be like a lead underwriter, right, like Payne Weber or somebody like that, then who's listed underneath it? All the associate underwriters, all the other people that are getting involved. So, for example, I'll tell you, that's what happened with INEL, that Intelligent Electronics, and it's going on right now. My stockbrokers are restricted from telling me anything about that company. So we call up Merrill Lynch. Guess what? They're restricted too. Something's going on here, is it not? So again, you keep your ear to the ground. Y'all catch that? That was at Intelligent Electronics. By the time the people at home watch this, it's probably going to be all over and done. Something's going on with that company right now because all the big brokerage houses are restricted on that company. Now, I can solicit information from them. They just cannot call me and say, hey, we got a hot one going. They can't do that. But if you've got two big brokerage houses are restricted, does that tell you something, everyone? So that's another way of finding them. Call your stockbrokers. So I just called up my stockbroker the other day. I said, would you give me a list of all the companies you can't tell me about? And he did tell me about a couple of them, right? But they can't tell you about it. They can't tell you about them, right? He said, well, I can't tell you about this one. Okay. Now, he wouldn't even do that. He wouldn't give me, I tried to do that. So I said, give me a whole list. He wouldn't give me that. He wouldn't even give me 1 or 2 of them because they can't solicit you, right? It's not that they could lose our license, right? But their internal company policy, the company, right, the management of the company will not let them disclose information to us. I thought that was a pretty clever thing to do, and it didn't work. All right. So we found that company when we called him. So, by the way, this happens a lot. About every 25 or 30 companies that I'm calling him about, he'll say, we're restricted on that stock. And then I said, well, what's going on? I can't tell you. By the way, usually they don't even know, right? But do you know something's going on? So then you can, by the way, could you in fact then just call the company? Which we've done that a lot. We just call the company and talk to the CPA and say, what's going on? So we can't really tell you very much, but we're merging with whatever.
What do you mean you solicit them? Say, okay, I want to know about the company.
If you call up and say, I want to know about this Intelligent Electronics, they'll say, okay, it's got this and this and this going, this and this and this going. Say, well, what's going on? Why are you restricted? They won't tell you why. They won't tell you that there's an offering going on or anything like that. You just don't know. By the way, I like these. I bought a lot of stock in these things. For example, on that INEL, I bought an option at 50 cents that very day, and it was at $2 the next day. Quadrupled my money in one day. I should have sold it, but like an idiot, I got greedy again, and it went back down to $1.25. And it's, by the way, last time I checked, it was still at $1.25. I've still more than doubled my money. Right? This is like a December option. I'm waiting for it to go back up again, like another $1. Then my option will go back up to $2 or $3. No, it may be done. I don't know yet.
Okay, Wade, I found out about a company that's going public, and I was told by my broker at Merrill Lynch that they were bringing them out,
Right?
and that all the, I guess there was so little stock, and there was too many big players to gobble up all that stock
Right.
that somebody like me couldn't go in and buy a couple thousand.
Is that what I just said, everyone? That's General Magic. That's Boston. That's all. That's the way it is on all these.
So the question is when?
So watch this. This is a perfect example. You watch it. Do you know what the stock's coming out at? What price?
I have it between 17 and 19.
Okay, 17 and 19. You watch it. Within a day or two, it'll go up to $30 a share, maybe 32 or 33, and then it'll settle back down to 17 or 19, where it should have been in the first
So,
place.
as a small investor, my question is
Wait.
when do I buy it?
Will you buy it back where it was originally came out at, and or under that, if you still think it's a good deal? Okay. By the way, do a lot of other people think it's a good deal to even bring it public? What do you think? A lot of people are gambling on this thing being a good deal. So about 2, 3, 4 weeks later, I can't tell you when exactly.
Can I get in on the initial deal when they start trading?
Do you want to do that? Okay. So.
You know, that first day when you said...
So if it comes out at 19, you put in order to buy a bunch of $20. Yeah, you could try it, but I'll bet you start chasing it all day. It'll go so fast. You watch. I mean, you ought to see a company go public and just sit on the phone with your stockbroker for an hour. You'll be amazed. You'll say, okay, can I get some at 22? Yeah, no, it's 23 already. Well, give me some at 23. Sorry, it's 24. I mean, it just happens just that fast. Oh, heavens, they know, don't they? They know all this kind of stuff. They're mailing out brochures and prospectuses. They're mailing out all. They know exactly when it's coming out, and it's on their computer system. Anybody can find out when it's coming out. We don't know what's going to happen to the price. Okay, once you get into the IPO newsletter thing or look in Investors Business Daily, sometimes in the Wall Street Journal, you can find out information on IPOs left and right. Right? It's a great place. By the way, you know what? Almost never do they have options on them. Y'all catch that? Because the stock is so new, it takes a while for the stock to kind of settle in, build up its own base before it has options traded on. I'd love to be able to buy options on IPO, but you can't do it. I've just never found one that has options available on the IPO. Okay, let's move on. The next area of investment, number 3 on page 40, is spin-offs. A company spinning off. I'm going to tell you a quick story, and so you can see how good a spin-off investing can be. I like spin-offs, everyone. I really like them. As a matter of fact, on our stock split page, we have that Office Max. Excuse me, Will. Do we have a price on Office Max right now? And by the way, could you call Dale or Randy and find out what the stock originally, when it spun off, what that stock came out at and what it's at right now, just to prove the point? All right, here's what happened. I'm going to tell you about Kmart. Now, you've all been into Kmart, so this is a good example. You all understand Kmart. How many of you have companies called, a store at home called the Sports Authority? Okay, only about 5 hands. They're not, well, I think we have one here now. Do we have one here in the Northwest? I think we have one up in Bellevue, but they're like Southeast, you know, Atlanta, you know, they're all over the Southeast, right, the Sports Authority. And they're a huge building. Now, guys, I've been into a lot of, you know, big sports-type stores, Sports Dominator and some places like that. You can take a typical huge sports complex and stick like 9 or 10 of them in one Sports Authority. For example, you California people, you have down there Staples, do you not? Staples, right? You can take into Office Max, you can put about, well, Office Max, by the way, is about as big as Home Depot. How many Staples could you put inside Home Depot? About 20 of them. I mean, a huge, you know, Office Max and Office Depot, you know, these warehouse-type stores that sell office products and computers and things like that. Kmart stock, and by the way, the ticker symbol on Kmart is KM. Kmart stock is floundering about a year and a half ago, 12 to 13 bucks a share. By the way, do you think that the stockholders get kind of tired of the stock not going anywhere? And by the way, do you think the stockholders get tired of walking in and seeing the same old scungy Kmart stores? What do you think? Floors that are just, you know, linoleum that hasn't been replaced in 20 years. What do you think, everyone? And the same stale little Subway sandwiches and the same stale thing in the back, right? And everybody else is improving. You know, Walmart comes out with a whole new bunch of stuff, and this store opens up, and they got all this razzle-dazzle stuff, and there's Kmart, right? Same old sign that they had since 58 or something like that. What do you think about the shareholders? Do you think they could literally go to a shareholder meeting and say, come on, man, get this thing in gear? What do you think? And that's what they started doing. They started complaining like crazy that Kmart stock's not going anywhere. Hey, we want to gamble on this stock going up. Sears is doing better. We're not. Walmart, by the way, let's talk about Walmart. Talk about stock. We're going to do we'll do stock splits when we get to number 5. I'm going to talk about Walmart. Kmart stock is floundering. $12, $13, $14, $15. By the way, last August I bought a bunch of it at $15.50, and I sold it about 5 days later for $16.50. Let me tell you what happened in the meantime. I bought the stock to capture the dividend, right here. I captured a 28-cent dividend last August, and then I sold it a day later for $16.50. So I made a nice profit on that. It wasn't because of the dividend, which is a fairly, it wasn't a great dividend, but it was okay. But here's what they announced. During that time, Kmart announced that they were going to sell off 3 divisions of the company. One division of the company was called the Sports Authority. I'm just going to put up the ticker symbols, TSA. All right? What was the ticker symbol for Office Max? Does anybody remember that from this morning? OMX. Was OMX. And Office Max. And I don't know the ticker symbol on this next one, but it's Walden's. Have you heard of Walden's Books?
Yeah.
And Borders. Right? Kmart owns all these companies. I know. I know. By the way, you'd be amazed at, when you start learning about who owns what out there. For example, who owns Snapple right now? Yeah, so it's Rush Limbaugh. No, Quaker Oats. By the way, ticker symbol on Quaker Oats is OAT, oat, right? And by the way, who's trying to buy it? Well, we've been hearing rumors that Coca-Cola is trying to buy up, not just Snapple, but they may buy Quaker Oats. Don't know, right? I mean, if you start looking at what companies own what and all that, it's pretty amazing, right? There's a lot of companies own each other, a lot of inbreeding going on out there, right? Companies gobbling up other companies. All right. So here's Kmart that owns all these companies. Now, you have a box on page 40 right there. Is it page 40 that we? Yes, page 40. You have a box with a little angle down at the bottom. That is a typical spin-off, right? So before I move on, I want to make a list. Here's the parent. Here's the big company, and it's going to spin off a little baby company, right? Tell me why. First of all, tell me why you think this may be a good investment. Why?
Well, there's management in place.
That's right. So they have not only management, but they have employees in place, right? Is that a big thing, everyone? Because you're not starting new, right? It's an existing company. This is division of, a subsidiary of a parent company. What's another reason? They have, well, let's cover that one in just a minute. They have a market niche. They've already discovered their what? Their marketing plan, their locations, right? They have a market. They have traffic. They have business. And hopefully they have profits. They usually do have profits. Okay, another one that a lot of you said is what? Money. They have money backing them up. All right, so now let's get specific and see how this is a good play. Kmart, which needs some cash to kind of update its stores. Shareholders are tired, needs to get involved in some other investments. The shareholders are tired of the company. Kmart announces that they're going to sell off not one company, but 3 companies. They announced that they're going to sell off the Sports Authority, TSA, for $900 million. Oh, and they're only going to sell off 51% of it. So Kmart, the parent, is going to keep 49%. I read a report a couple months ago, by the way, that says they own 46%. But the original spin-off, they were going to own 49% and spin off 51%. So they're going to sell off 51% of a company for $900 million. They did, basically an IPO, right, on that, and it sold out by the end of the first couple days. $900 million bucks. By the way, that's almost $1 billion, is it not? Can a company like Kmart do a lot with just under $1 billion? There you go. Okay, so which one do you invest in here? Do you invest in the Sports Authority or in the Kmart? Both, possibly. Kmart went from $14 and $15 up to $19 and $20 a share with this announcement. It's going to raise all this cash. Now, the Sports Authority, again, has its own marketplace, has a management, employees. It's a profitable enterprise. And then it's going to spin off Office Max and then Walden's and Borders. This one, by the way, was losing money. These other 2 were making a lot of money. And Kmart's going to raise a couple $1 billion in selling off these 3 divisions. Good for Kmart stock? Yeah. By the way, we're up 19, 20 bucks, and it's right back down around 13, 14 right now. In the last year. I guess they haven't done that much with all that cash. Okay, now, you said parent. The reason you gave rule number 3, or reason number 3 for investing is that there's a parent backing it up. What does that mean? There's a parent backing this up. Well, what if the Sports Authority needs some money about 3 or 4 years from right now, and it can't get a loan at the bank? Where can it go? Well, by the way, where do kids, I don't know, 26, 28, 32 years old, where do the kids go for money? Back to mom and dad. How many older people got kids that have moved away? Does that happen? It's like once a parent, always a parent, is it not? Now, they may not bug you that much, but are you always there to help them out if they need to help, right? You're there. You're parents, and you're going to always be parents. Specifically, why is Kmart going to loan money here? Yeah. Do they have a large financial stake, a large reason for this company being a success? You better believe it. So there's mom and dad with a huge financial stake. Now, you guys in this room that have kids that have grown up and gone away, you probably don't have a 46% financial stake in your kids, right? That'd be nice to get 46% of everything they make for the rest of their lives, but you probably don't, right? You do? You put them through medical school? All right, you see the point? But we usually don't. So what? But this company does. This company has a large financial stake in getting this company successful. All right, you see the reason behind spin-offs? I like spin-offs. Right? Did you find out anything on Office Max yet?
Yeah, it's new. They're doing a 3-for-2 split, date of record 6/30, split effective 7/12. They're still 25% owned by Kmart.
You all hear that? So let's say that again, Will. It's doing a 3-for-2 split. By the way, was that on our stock split page? It was, right? Find that if you will. Is that right? Did it say 3-for-2 or 2-for-1? 6/30? So the end of June, which is in a few days, on 6/30, this company's going to do a 3-for-2 split. Right? It's not a 2-for-1, but it's a 3-for-2. You know what the stock is going for right now?
Yesterday was 27 3/4.
So what would 3-for-2 do to that thing? Almost a third, right? So it's going to go to, what, $18 a share? So for every share you own at 27, for 2 shares that you own at 27, you're now going to have 3 shares at 20 or 19, right?
Close today at 27 1/4.
They're 18. What's that?
27 1/4.
27 1/4. Boy, it'd be sure fun to check some options on this one. Would you check some 25s like in October, November, and some 30s, and let me know when you get those? What do you think, everyone? Like stock splits? You're seeing it in action right now. Now, I didn't bring up the spin-off to talk about stock splits, right? This was spun off from Kmart less than a year ago.
October 31st.
There you go. October 31st. It was a spin-off.
Today was 23 to 24 and 7/8, 19.3 million shares traded.
Today?
No, that was the day it spun off.
You catch that, everyone? Want to know how many shares traded in one day? 19.3 million shares in one day. Now remember that may be market makers buying from each other, to find the stock and all that. So it may be even half of that. But is that still a lot of shares in one day? On October 31st. Nice day, Halloween, right? Kmart spins off a company on Halloween. Okay? Kind of interesting. 3-for-2? How much? 16? It should be $16 or $17. Right, $18.16. So, if you take this times 2, should equal this times 3. Correct? Because you're getting 3, 4, 2. So for every 2 shares of stock you own, I'd like to know the rationale. I would have loved to have been in that board of directors meeting and find out why they're doing a 3-for-2 stock split. Would anybody else like to know that? Why not? Why are they doing a stock split at all when the stock's still at 24 bucks? Right? It's okay with me because I'd rather buy the stock at 18. By the way, does this get back down in our range of covered call writing? So we didn't see very many over $22, $23 that made a lot of sense, right? So a lot of $12 ones. Now this is back down to 18 bucks a share. I like it. I'd love to get some options on this one. We got to check that out. Okay, now again, I'm kind of like ahead of myself, but we're already starting into the inoculation of investment strategies. Oh, come on, that's the only big word I'll use in this whole seminar. What is it? Yeah, $10 word. No, it's an $18.16 word. Inoculation means to blend, to weave, right? So we're talking about putting a strategy on top of a strategy. Watch this. I'm going to show you inoculation right now. You've got a stock that's at 27. Can you buy that stock on margin? Yes or no? Yes. So you buy that stock on margin, so you only have to put up half the money. Then it does a stock split. Right? Now you have 3 shares for every 2 shares that you own, but it gets back down under 20 bucks. What is there going to be a tendency for the stock to do? To regain lost ground. I'm just making a prognostication here. I've been wrong more than I've been right on these kinds of things. But if you watch this thing by this coming October, I'll bet you anything it's up around 25 bucks again. Watch it. You all mark my words on that. So those of you right now, you go back, if you're getting this 3 years from right now at home, you go back to October of 1995 and tell me where OMX was in October 1995. It's going down to 18 bucks a share at the end of June. You watch what happens to this thing. Right? Now, would you like to then get some options on this thing? And why? Why would you like to get options on this thing at, say, 20 bucks or at $25? Because you're getting involved in a leveraged play, right? A proxy play where you're not buying the stock at $18, you're buying an option at $15 or at $17.50 or at $20 for a small amount of money. And then you wait for the stock to go up. See, those are the different strategies. And by the way, are we doing this not only on a spin-off, but are we doing this on a stock split? You see how all the strategies start coming together? See, to me, everyone, the stock market is like one big, gigantic hole. You got some option numbers? This should get interesting. Okay, here's the chart, everyone. Wow. We should have been rolling this thing, Will. Look at this thing. This is $20 right here, and this is 26 right here. Okay, where's the stock right now? 27 and 3/4, 27 and 1/4 right now. Okay, what are these? What are these, Will?
Those are the December 25s.
Okay, let's do this, everyone. So right now, the December $25 calls, if you didn't want to buy the stock, you wanted to buy the option, are, which numbers here am I looking at?
All 3 different market makers.
3 different market makers here? Well, just give me one. Just give me a good one here.
3/4.
The 4 and an 1/8 and 3 and, what is it? Okay, I'm looking at 4 and an 1/8 by 4 and 3/8. Is that this one right here in the middle?
In the box.
Okay, in the box. Okay, this is the 30s. Okay, so is it December again? The December $30 call, 3 different market makers. Look at this, everyone. 3 different market makers. 1 1/2 by 1 3/4, 1 15/16 by 2 1/16, 1 3/4 by 2. Now, does a market maker do they all have to agree? You've got 3 different warehouses selling pineapple. Do they all have to agree on the price, or can they sell it for whatever they can get? See the point? So you got 3 different market makers selling an option at 3 different prices. So could your stockbroker go to the best one and shop for you? What do you think? By the way, could he even call 2 of them and say, hey, I can get it for 1 15/16, will you give me 1 3/4? What do you think, everyone? They can shop for you. They can make deals for you. Right? What do you think, everyone? That's pretty far out of the money, isn't it? Now watch this, though. What happens with this? Because when the stock does a split, 27 3/4 down to $18.16, what happens to the $30? What does it go down to? I don't think so. Probably $22.50 or something like that. I'm just guessing. What do you think? Well, that times 2 would be 60. You take this times 2, right, would be 60. Then you take that divided by 3, would be 20 bucks. So, if you're buying, what are you buying now? So here you have 2 rights to buy this, right? Now you're going to have 3 rights to buy it at this. You see the point? So the stock splits, the option split, the same way. I like it, everyone. Yeah. So the stock's at $18.16 if you stick with our other numbers from a minute ago. And now you're buying an option to buy it at $20. And you're going to pay right now, which one do we like? Let's stick with this one. They say you pay 1 3/4. What's that times 2 divided by 3? Right? So we do that for me. Take 1.75 times 2, right? Because you're getting 2 shares. You got to take it times 2 is what? Then you divide that number by 3 because you're getting a 3 for 2 stock split. What is it? $1.17? So you're paying $1.17 for the option times 100, if you're doing 1 contract, times 10 if you're doing 10 contracts. So you're paying $1.17 and hoping for what? That this stock goes to what? To $20 between the end of June and December. What do you think, everyone? I like it. I like this one a lot. Okay, I wish the market was still open today, because I would definitely be doing this one. I like spin-offs, I like stock splits, and I love options on stock splits. right? This is a nice deal, everyone. So write this down. Whether you want to do this or not, that's up to you. You've got to make those decisions. This one, I don't know. Do you know where these were from? They were just market makers. They're not. This was not an exchange. These are just different market makers on the exchanges. These are the actual market makers making a market. Okay, where are you guys with your heads right now? Okay, do we need to cover any more on spin-offs? You understand the reasoning behind spin-offs? Okay, how do you find them? How do you find a spin-off? Can they be listed right in an article in USA Today or the Wall Street Journal? What do you think, everyone? By the way, they are definitely in Investors Business Daily. You can see spin-off reports in Investors Business Daily. And may I make a recommendation? I love the Wall Street Journal, mainly because I like the editorial page. That's one of the most conservative editorial pages in the country. It's still way, too far liberal for me. I mean, I'm so far conservative. I mean, I'm like 14 miles to the right of Ronald Reagan, right, as being conservative. Now, so I like the Wall Street Journal for the editorial page and some of the news reports in there. But I really like, everyone, is Investors Business Daily. If you're not subscribing to that, you should. There are reports in there, information in there you just cannot get. They are so detailed in just these kinds of companies doing this kind of stuff. There are reports in there. If you don't subscribe to it, pick it up once or twice so we can flip through the back part of the pages, and you'll see IPO reports, insider buying reports. By the way, would you like to know about companies where the insiders are buying up a whole bunch of the stock? See the point? So there's all that kind of stuff in Investors Business Daily. There's more news than you can even fathom. Even gathering in one brain in one day.
On that one, you were talking about Kmart where they got 3% off.
Yeah.
You said the first two were making money and the third one was not.
Walden's and Borders Books was losing money, and I don't know what happened to it on the spin-off. I haven't even heard if it actually spun off. Okay, let me ask you this. I don't know what happened. Macaw Cellular. How many ever heard of Macaw Cellular? Cellular One and all that? This company lost money 7 years in a row. 7 years in a row was losing money, and then it went public, and the stock busted loose and went crazy. Why would companies, why would people buy a company that's lost money 7 years in a row? Why did Cellular One lose money? How come? They were buying licenses, city after city after city. Once you have a license arrangement with a city to have cellular services, does that become a cash cow at some point? Does everybody understand the word cash cow? In a company, a cash cow is what? Ivory soap is a cash cow. Why? Does the company, who markets Ivory soap? Is it Procter & Gamble or John? I don't know. Who cares? Do they need to advertise Ivory soap? No. Has it been around for a long time? Since the turn of the century. Is that a cash cow? It just keeps producing income, producing income, producing income without hardly any advertising. Once a company has a cellular license base in a city with 38,000 subscribers using their phone, does that become a cash cow? You keep paying their bills, and it just keeps making money, right? So who knows why a company goes up or down? Maybe Borders and Walden's has been expanding. By the way, could that cause it to lose a lot of money for a while? But as it opens up store after store after store, hey, I'm hearing that Borders is expanding. How many of you have been into a Borders bookstore? They are nice bookstores, are they not? They're nice, and they're well run. Okay, so I don't know. I don't know what happened to it. Can we check that out, Will? Do you have any way of finding out what the ticker symbol on Walden's and Borders is? Did they form a new company to own those? I don't know. Check that out, if you will. All right, the turnarounds. We talked about these yesterday, number 4 on page 40, turnarounds. We've talked about these. We don't need to belabor this point a lot right now. This is a company that is down. Tell me some reasons why a company could go down in value. Why? Bad management. How about losses? Okay, what else? Lawsuit. A lawsuit, by the way. Can that drive a company from $30 down to $3 a share? Just a major lawsuit. Okay, what else? Hey, bankruptcy. Right? I mean, really losing money. I mean, I could go on. I've only got 3 of them that are listed there. You could get 10 different things, right? Natural disaster. Losing a base. How about competition? How about, the stock's gone really far up, but then all of a sudden, listen to carefully. Excessive profits breed ruinous competition. Let me say it again. Excessive profits breed ruinous competition. What does that mean? If a company's going along big time, what does everybody do? Oh, man, they're making all that money selling widgets. Hey, Frances, man, we could take her on. We're the big guy. She's just up there in Seattle area doing her little widget thing. Let's go take her over. Let's go into competition with her. By the way, when I see a lot of these multi-level type companies selling a vitamin pill or a shampoo or whatever, if it's really as good as they say it is, where's it going to be within a month or two? It's going to be on the stores of Pay and Save, right, in Drug Emporium. What do you think, everyone? If it's really that good, the big companies are going to take it on. Are they not? You see the point? Excessive profits breed ruinous competition. So, a company goes down. Okay, why does the company go back up? Exact opposite of everything we just said. It comes out of bankruptcy. It gets a new manager. Oh, by the way, I'll give you an example. Kmart would be considered a turnaround right now, to my point of view. Kmart, 12, 13, 14 bucks a share. About a month or two ago, Kmart made an announcement that they're, well, I think they said kicking out, but they're getting rid of, or he's going to retire or whatever, the president, the CEO of the company, right? Now, in normal companies that are going to lose the president, what happens to the stock? It goes way down. What happened that day? Went up $2. They want to get rid of this guy, right? So his leaving is, you know, what is this? Is this Kmart? All right. By the way, this is probably the day he left, right there, right? Seriously, it was back in the first part of May, and as soon as they announced it, it went up like $2, $3 in one day, right? Because that was good news to the shareholders, okay? You see the point? So why does the company go down? Why does the company go up? These are called turnarounds, right? And okay, now let's move on. Stock splits. Okay, number 5 on page 41. Why is a stock split so good? We've been discussing this for 2 days on and off for a couple of days. Why? The tendency to regain lost ground. Okay, why does a company do a stock split in the first place? Again, gets too expensive. They want more people to be able to buy it. Okay, for example, the ultimate, and don't quote me on these numbers, I don't know, but I just heard this, I can't remember exactly what it is. Had you bought Walmart? By the way, how many of you wish you would have bought Walmart before I even tell you this story? How many of you have seen what happened to Walmart? Not just because the stores have expanded and they've done a good job. Are they going into Mexico right now? They're going all over the world. You watch Walmart, it'll just expand everywhere. I mean, Sam Wall is no longer there. By the way, has the stock kind of floundered since he passed away? Anybody followed it? It has just floundered, everyone. 22, 23 bucks a share. Do you know what Walmart's at right now, Will? Right? Let's check it out. Walmart, okay, the ticker symbol is, what is it? WMT. WMT on Walmart.
25 and 3/4.
Okay. Okay, there it is. Now, it's gone up a little bit, but it's right around that $23, $24, $25 share range. All right. In 1961, when Walmart was formed, the stock came out at whatever price. Had you bought $10,000 worth of stock in 1961, I think I read the report, you'd be worth today something like $1.8 million. That stock, since 1961 to 1995, that's 34 years, that stock has split something like 26 times. So almost every year, that stock has done a 2-for-1 split. So whatever you originally owned, right, however many shares that $10,000 bought you, now you have twice that many shares. A year and a half later, you have 4 times that many shares, right? And by the way, the stock has always had a tendency to go back up to that $20 range. All right? Now, I'm waiting for it to go back up to like $30 and watch it split back down to 15. Right? And then wait for it to get to $30 and split it again. Right? You watch Walmart, everyone. There's a classic case of splitting the stock. Did Sam Walmart become one of the richest men in America? Oh, and they always joked about him driving his old pickup truck, right? He had that old Chevy or Ford pickup truck, and he did not have a Mercedes or a Rolls Royce or a limo, right? He always drove his pickup truck. But did that guy know business? No, he knew retailing. And where did he go, by the way? Did he go into the big cities at first or into rural America? He went into, there's all those cities, right? And did, by the way, see, here's a question with a company, and you got to watch this in your own investing. Do you want to be the biggest fish in a small pond or the smallest fish in a big pond? What would you rather be? What did Sam Walmart decide to do? Sam Walmart. What does Sam Wall decide to do? Sam Walton. Is it Walton or? Walton. All right. He wanted to be the big fish in a small pond in Snakes Navel, Wyoming. Right? Seriously. By the way, I travel the country all the time, and I go to these cities, and I can't pronounce the words half the time. You know what the city stands for? So I went to this one city, and before I got up and did the seminar, I went into this fast food place, and I says, look, I come into towns and I do seminars, and I never get the name right. Would you tell me, really slowly, will you say the name of this place? And the guy goes, Dairy Queen. All right. How do you find these stock splits? Where are they listed? Could they be in the Wall Street Journal? And by the way, could the article say, this company is doing a 2-for-1 stock split? Right in the headline of the article. What do you think? Yeah. They're everywhere. By the way, what did we find out here? Where's a good way of finding these companies here in class? That S&P. The Standard & Poor's, one of their news, on their main menu, they have a stock split section. Right? And any company that's announcing a stock, whether big or small, is going to be in there. Could you find these out every day? Because, by the way, we missed Office Max. How many would, it would be fun to find out where that was last week, you know, right before the stock split. Because when was it announced, everyone? It was on that stock split. Was it the last couple of days? Yeah, it is. It was on that piece of paper that you have. Well, it hasn't split yet, but okay, so that's the question. Let's stick with stock splits for a second. If you haven't got that answer down, then I'll ask the question. Where Nope, forget that. When should you buy the option or the stock? But when should you buy the option on the stock? When they first make the announcement, or should you wait until it actually splits and the split is reflected in the price of the stock? Because what happens? Okay, so the company like well, this one we're talking about, Office Max. I don't know what the stock was last week. I'll guess it's 25 bucks a share. Is this a guess? So Office Max a week ago, this is my guess, I'm putting a question mark by it, was $25 a share. They announced a 3-for-2 stock split, and what has happened to the stock in the last week? Up to 27 3/4. All right? Now, had you purchased the option on this stock at either 25 or at $30, would you be a lot closer to that already? So if you would have got this the very day they announced a stock split, right, then you could have got that option and say, you know, what was it here? The equivalent of like $1 3/4. I bet you could have got it for $1. No. You know what? I wouldn't rely on that anyway. The question is, does an article ever say something like, this company is contemplating a stock split? No. By the way, would that be manipulation of the news and all that? But they couldn't do that. When are the stock splits made? The board of directors get together, usually at their annual meeting. By the way, you know what? You can almost time these things. I'll give you an example. Novell Computer in Salt Lake City. I'm going to show you one, everyone. This is an amazing story. This was like 1988, 89. Novell Computer. This is before they took over WordPerfect and that Quattro Pro thing of Borland, Gorman, Lamont, whatever that stuff is. I'm just not into computers. Every time I have a computer name, it just drives my brain crazy. All right, Novell, N-O-V-L. The stock is right around 30 bucks a share. It goes up from August of one year to August of next year to $60. They do a 2-for-1 split. Now you have 2 shares at $30. The next August, right, a year later, it went up to 60 bucks again, and you now have 3 shares because they did a 2-for-1 split, and now you have 4 shares. The next August, it went up around $58, $60 a share and did a 2-for-1, and now you have 8 shares. Everyone that did this, I mean, where do I got to go? Now you have 8 shares at $30. The next year, up to 60, split back down to 30, and the next year up to 60. 5 years in a row. 5 years in a row. By the way, when do they have their board of directors meeting? Every August. So guess what they announced at the end of August, the first part of September? A 2-for-1 stock split. Seriously, everyone. So do certain companies have tendency to do stock splits a lot? Does Walmart? So all you do is follow Walmart, right? So you see that you get familiar with certain companies. You know that they're going to do stock splits, you know, because can a board of directors be really stock split minded? And they were. By the way, do you understand now when I talk about Novell, why when the stock went down to 30 the last time, and then it started taking over other companies and doing this and that and the other thing, and the stock got down to 20? You see why I was waiting for it to get back to 30 and 40 bucks a share? Because it had done it 5 years in a row. I was making a little mini fortune on Novell during that time, right, waiting for the stock to go up and splitting it down to 2. But the last time, guess what? It's been about 2.5, 3 years. Well, this August it'll be the 3rd year. It hasn't done a stock split in the last 3 years. And the stock's been floundering around 20 bucks a share. But boy, was that a good ride for a while? I'll bet you if the stock got up to 60 bucks again, they'd probably split it again. I don't know. That's just my guess. I don't know. Okay. Yeah, you can find out there. Yeah, just call the company and say, when are your annual meetings? And by the way, if you buy stock in it, even if you buy 10 shares of stock in it, will they send you the information on the shareholder meetings? And then if you want to go, you can go. And by the way, will they discuss right there whether they're going to do stock splits right in front of the shareholders? You bet. They sit right there and say, okay, our next item is whether we should do a stock split or not. And the board of directors sits up in front, and they can discuss it with the shareholders right there if they want to. They usually don't. That's usually closed. But something they can do it right there. By the way, what if you get a statement like this? Microsoft is having an annual meeting. One of the points on the annual meeting is that they want to authorize another 50 million shares of stock. By the way, this happened a year and a half ago. January and February of 1994, Microsoft wanted to authorize another 50 million shares. Why? They've got $1 billion in the bank. Do you think they're authorizing more stock to raise money? Yes or no? Absolutely not. What are they doing, everyone? And as soon as they said that, I was telling everybody, hey, they're going to do a stock split, they're going to do a stock split, right? And I started loading up on the stock, right? And sure enough, a month later, we're doing a 2-for-1 stock split. They announced it in April, and in May, they did a 2-for-1 stock split. Why did they have to authorize 50 million more shares? Why, everyone? Because they can't issue stock unless it's authorized. So they had to authorize 50 million more shares so they could issue 50 million more shares on a stock split. So when a company's authorizing a lot more stock, right, in their annual reports, you know they're getting ready to do something. Acquire another company, right? What do they need stock for? By the way, is stock like money? So they could go out and acquire a company with stock. They could do a stock split. They could issue stocks for dividends with another authorization of stock.
Did they
Okay.
do that trying to get a hold of Intuit?
You know what? I don't think they did. I think they were going to do Intuit with cash, weren't they?
I don't know.
Yeah, they were going to do that with cash, I think. Maybe some stock, but I think it was cash. All right, Office Max is right here. Second computer screen down on this piece of paper. All right, and I don't know when it got put on this return, this form, but boy, I missed this one. I would like to have seen this one. It's not going to actually happen until the middle of July, but I'll bet you anything, everyone, you watch this one, and it's going to hit like 30 bucks a share before it actually does a split. Okay, this Office Max one. This Mark, I mean, can't make any, actual predictions on this, but you watch what happens on these kinds of companies. Okay, how many of you ever heard of the Cirrus Logic? All right, we ought to be checking that one out too. Well, let's check that one out. That Cirrus Logic. What's that? Office Max is behind me? Is this Office Max on the screen again? Yeah, but I want to look at this CRUS, because that's another 2-for-1. All right. How do you find them? I already made the list. Newspapers, call your brokers, get these kinds of lists, right? Keep your ear to the ground, and you'll find out about these. All right, let's move on. Number 6, dividend capturing. CRUS was Cirrus Logic. Whoa, look at this, everyone. 65 bucks a share over there. In December of last year, it's down to $21. All right? So, again, why is this company doing a stock split? More than likely, why? What's their rationale? I bet you they have a lot of profits, and they're going to issue a bigger dividend, right? And we got to check the options on this one tomorrow morning, all right? What do you think, everyone? It's going to do a 2-for-1 split this is Cirrus Logic. It's going to do a 2-for-1 split. Record date was 6/19. It's going to, the ex-dividend date is 7/18, right? It's in 3 weeks from right now. CRUS. All right, that's another one. Well, it's going to do a 2-for-1 split back down to 30. Now, okay, so Marianne, am I going to buy the stock at 60? Am I going to buy the stock at 30, or am I going to buy an option on the stock? And what do you think I'm going to buy? When I go shopping tomorrow morning, right, class will be over, right, and if you want to find out what I'm doing, you'll have to check into Win. You'll find out what I did on our Wealth Information Network. I will show that tomorrow. What do you think I'm going to go looking for? So the stock, what is the stock, do you know? The 65 bucks right now?
4 5/8.
Okay, 64 5/8. Let's round off to 65 so it's easy. So if it stayed the same, which we probably won't do, but if it stayed the same, it's going to go down to 32.50.
1.1 million shares.
So what do you think I'm going to do, everyone?
35.40.
I'm going to go looking at, how about the 30s? So let's go price out the call, what month? Way out there. Should we check and see if there's a leap? So the first thing we're going to check, everyone, is a leap. Why a leap, everyone? By the way, could we look at the 96 and the 97 leaps if they're written? What do you think? Check them out. But at least, if there's a January of 96, that's probably what I would buy. Okay, now, what if there's not a January? What if there's not a leap written on it? So what should we be checking out? October, November, and December. Something way out there, right? Give this company how many months? As many as you can. 3, 4, 5, 6 months, right? So I'd be looking at a call of $30. Okay? What's that? Yeah. Can you flip this back? Or you can. Okay, this, you want to see this on the screen. Can we put my paper back on the screen? Right. Well, hold it. The 65 was split down to 32.50 because that's where the stock is right now. I'm going to explore a call at 30. By the way, will that be intrinsic value then? Because if the stock's at 32.50 and we're getting an option at 30, part of the price is going to be intrinsic value. And I'd probably look at the 32.50s. By the way, will there be a 32.50 even though it's in $2.50 increments up to 25? When it does a stock split, will that become an option price probably, right in that range right there, right? So there may be, because a 32.50 would have been a 65, correct? If there were 65 written on it, that'll become a 35. What if there's a, well, that you may know my point. If there's a 55, then it becomes a 27.50 or whatever. Okay, so I would look at the 30, the 32.50, the 35, and the 40. This is all pre-split, is it not, everyone? So all we have is an announcement, and we don't know when this announcement came out, right? A couple days ago, probably. I'm talking about the December, yes. So right now, you'd be calling your broker about the December what? You got to double everything here, right? Because you're pre-split. So you call up your broker and you ask for the December, 60, 65, 70, and 80. And this will be post-split. So this post, this is pre. And right now, before the stock splits, before it's reflected, you've got to go with the pre-split pricing. All right? And then again, what will happen? When the stock splits, what will happen to your options? They'll split and you'll have double the amount of options on a smaller share of stock. I like it. Okay, I like all these we've talked about here. I mean, it's been pretty wild. Okay, any quick questions on stock splits before we move on?
Sell your option and getting a profit. Do you check to see what the actual stock is going for? Let's say you could actually make more by executing your option. Can you go ahead and execute it and sell it all in one breath without ever paying for the stock?
Okay, question. That's a great question, everyone. And this is one that you're all going to have to answer. You have gambled on a stock that was at $25. You hoped, prayed that this stock would go up to, say, $30. You paid $3 for that option. The stock went from 25 to 30 or whatever, and your option is now worth $5. Should you go ahead, and let's say that the stock at that point in time is worth $33 or whatever. Should you go ahead and buy the stock at 30 and sell it at 33, or just sell your option? What do you think? You won't make that much more. So now once the stock goes over the strike price, the option will pretty much trade tick for tick where the stock is, right? So if the stock goes up once it's in the money, when the stock goes up, and that's not totally true, but it's pretty true. Once the stock goes up $1, at some point in time the option goes up $1, right? And so now you got a $7 option going to $8 when the stock goes from 34 to 35. Y'all see that? And they just go tick for tick with each other. And now, by the way, is that a classic case of leverage? Because instead of paying $30 for the stock, you pay $3, and pretty soon they just go tick for tick.
The case was that you could make more by executing your option. Could you go ahead and execute it and sell it without having to come in with 10,000?
So you're saying, can you go ahead and sell the stock, I'm sorry, buy the stock, exercise on the option, buy the stock, and then sell the stock at the same time, the same day? Yes. Right. Well, yes. Well, you'd have to have money in the account. No, you have the 3 days to bring it in, and if you sell it the same day for a profit, but I've never done that. I've never done that. I just do the option. Okay? What do we have here now? All right. This is interesting, everyone. We're still talking about stock splits, and this is that Cirrus Logic, ticker symbol CRUS. Okay. The December... Okay, you know what? I'm going to put back up the page that I had. Right? I'm going to put back up this page. Y'all remember this one? Okay, I'm going to use a different color of ink now. The December $70 call is right now at 5 3/4 by 6. The December $65 call is at 7 3/8 by 7 5/8. All right, now, this is a good exercise. Which one of these do you want to do?
When it's that high, don't you think they're saying that it's so high that they expect it to happen, therefore you should maybe buy the stock?
Well, you can buy the stock, and I've done a lot. You know what? I did that exactly with Dow Chemical, and somebody yesterday asked that same question. I just go ahead and buy 200 shares of the stock. By the way, with 200 shares of the stock, how many options could you have purchased? See, you're not talking about buying 2 contracts of the option as compared to 200 shares of stock. 200 shares of stock, the money required to do that could buy how many options? No. How much? Instead of spending $65 for the stock, how many options could that buy at $5 a piece? You see the point? So you're leveraging in. If you got a limited amount of money and you're willing to take the risk, and it is risky, right? What do you think, everyone? Should I move that over? It's hard to see those numbers, but...
I do it.
Okay, so look at this. You're paying a little over $7 to buy the right to buy it at 65. You could pay $2 less. Actually, how much less is that? Not even quite $2, right? $1.50 less, but you have to wait for it to go $5 higher. Would you be better in this example to pay the extra $1.50 and get to 65, or try to save that $1.50 and get to 70? What would you rather have in the long run, by the way? The 65. So which is a better play here, everyone? 65. The 65. So that's the play right there.
What did it close at today?
What was it, 64 5/8 or something like that? Was that right? Yes. By the way, is that pretty cool? Yeah. So you got a stock split, 2 for 1, happening in about a month. This is a December, by the way. Both of these are Decembers. So you got 5 or 6 months now. How many months until December? Till the 3rd. You got 5 months, or 6 months, is it? 6 months from June. Is it 6 months from July?
6 months.
6 months for this stock to get up over $65 on a 2 for 1 split. What do you think, everyone? I like it. Okay? I mean, I like this thing because look, it's all out of the money, but boy, could that get in the money real fast. It's already where? No, the 3/8, and it's going to be in the money, right? And what do you think is going to happen, by the way? This is a classic example of, you buy that one at 7 3/8 or whatever, or 7 1/2, wherever it is. Buy this one, you try to get this one like $7.50. You buy that option. Now, what would happen if the option got up to $15? You pay 7 1/2. Would you double your money? What would cause it to go up to $15 from $7.50? What would the stock have to do? It's going to go down to say $32.50 and back up to $36, $37, $38. And is that stock going to get back up, or your option going to get back up? You see the point?
Yeah.
Okay, so this could be another real good moneymaker. Does anybody else besides me really like this page?
Yeah.
Look what we've learned on this page in just 2 days. How many good deals are on this page in just 2 days here, right? My goodness. I mean, from Texas Instruments to that Xilinx, to that Kulik and Sofa, to Office Max, and now the Cirrus Logic. By the way, don't know if you can see this at home, but look at how many of them we've... you know what I'm going to do? I don't care how dated this material is. I'm going to put this page in your kit at home, so you'll have this. Okay, so let's keep this one, all right? We'll throw it in the information kit so you see this page that we're all talking about, and you'll be able to see all the numbers. I know it's real small and you won't be able to see it, but you will be able to see it. So I'm going to throw this in the kit, and you'll be able to see what we're talking about here in class, so you know all these different numbers that we're mentioning. Okay?
In regards to splits, the record date is only a dividend number. We don't need to worry about the
Yes.
split.
All right. I think I got time to tell one last story, right? Here we go. One last story on stock splits, dividend payouts, ex-dividend dates, all right? Things like that. If you buy a stock, and we'll get to dividend capturing in just a minute, but it's the same information, so you can put a little bit of this information at the top of page 42. You can go in and buy a stock, whatever, buy it, and in 3 days, it will be in your account. What happens if on that third day, there is a dividend payment? Then you get the dividend. You've captured the dividend. Now, what if you buy it 2 days before, and it's not in your account until the day after the dividend pay? Then you do not get the dividend. Now, you have to buy a stock. If you want to capture a dividend, you have to buy a stock now 3 days in advance. And if there's a weekend, you've got to count for the Saturday and Sunday, so it'll be 5 days in that case. Now, there are a couple exceptions to that rule. But let's talk about ex-dividend. Ex-dividend means that date upon which, if you do something, it is X'd out. You don't get credit for it. So it's basically 2 days in advance, because you need to be 3 days in advance to have it in your account. However, there are a couple exceptions to that rule. Number one exception, if the company pays a dividend of over 25% of the value of the stock, then the ex-dividend date becomes the day after the pay date. If this company pays a large dividend, all right? Number two, if the company pays a large dividend of 25% or more of the value of the stock, then the ex-dividend date becomes the day after the pay date. That's the ex-dividend date. It's not 3 days before, it's the day after. All right? Number two, if the company is paying a dividend, a stock as a dividend, or a stock split type arrangement, then the ex-dividend date becomes the day after the owner of record date. Let me give you an example. You see on the page there, on page 42, a example right out of the Wall Street Journal. And you see there you've got the payable date, the owner of record date, quarterly, all the way down there. And you see a monthly, by the way. By the way, I'll bet you anything. Go down, you all with me on page 42? Go down to the 7th or 8th one that says M. You all with me on that? See where it says regular and then it says Q, 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 Q. And then all of a sudden there's an M. Remember I talked about MIPS? Monthly Income Preferred Securities. If you look over at it, guess what you're going to find? What kind of stock do you think that is that's paying a monthly dividend? What do you think, everyone? Look at the name of the stock. What is it called? It is called what? Something Bear Stearns, something, 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 Preferred A. There you go. So that's a monthly, that's a MIPS, right? They're paying a monthly dividend. All right. Let's go. As we came to the close of the Wall Street workshop, we wanted to make sure that all the students there and you at home crossed the finish line. The best way to do that is to show you how to implement these strategies in conjunction with each other. It is what I call the inosculation of investment strategies. The word inosculation means to blend or to weave together. You see, you can do covered call stocks on margin and write the options. Well, if the stock drops back, you can buy the options back. You can also buy options on those same stocks. You could do rolling stocks in an account that pays no taxes. You could also do rolling stock and also do options on those. See, once you learn the strategies, then the main strategy then is to blend them together to make sure that, yes, you have one or two main areas that you like and that you get to be an expert in, but then you can use these other strategies from time to time and blend and weave them together to make sure that you're really making a lot of money and you cross the finish line in great style. If you'll open your manuals to page 47, we're going to talk about some tax strategy investing, and then we're going to talk about balancing a portfolio for you, and then fully the inosculation of these different investment strategies, what I call stacking pancakes, and we'll get to that in just a minute. But there are two major tax things that we want to cover, as you know, and this is just a good way of helping you save money and not have to pay so much to the IRS. By the way, I like Ronald Reagan's statement a few years ago when he said, my idea of patriotism is to quit sending your money to Washington, D.C., and keep your money at home, building up neighborhoods, starting companies, creating jobs. By the way, is that a good idea of patriotism? Let's build up America from that point of view. If you feed the shark in Washington, D.C., well, if you feed a shark, what happens to it? It gets bigger. So we got to quit feeding that shark in Washington, D.C., and legally, legitimately, within the tax code, find ways of investing. Now, let me tell you my philosophy of investing for tax benefits. I've done now this entity structuring. We have people coming to our Cook University Wealth Academy, and we have people that are worth $6 million, $23 million, $18 million showing up and sitting next to people who are worth nothing. They had to borrow money to be there. Have a whole range of people sitting in a class. Get to work with them, some of these wealthy people. And I've noticed this, that wealthy people are wealthy because they purchase investments. The investments that they purchase usually are also producing tax write-offs. Y'all follow me on that? So somebody has purchased a 20-unit apartment building, a 19-unit apartment building, and a 36-unit apartment complex. The apartment buildings have grown in value. They got involved with leveraged dollars, then they've grown in value, and the income that they're making is offset by the tax deductions on the buildings. Does that make sense? So I see people that are trying to fight the IRS legally, to legally have tax-deductible type investments that are offsetting all the income. So I see people that are trying to fight the IRS legally getting wealthy. Now don't get me wrong. There's other people that are trying to fight the IRS. You've seen all these books, right? Every time I do radio shows, I do them live before I get out of the studio. There's somebody out there waiting saying, hey, you can get out of paying income tax by call yourself a sovereign citizen. Be a patriot, right? And they got all these little things that you can call yourself. And have you heard some of these kinds of things? I've got like 30 of them documented. And while I sympathize with some of their, ideas, their methods, these are always usually written by guys who wrote their books in jail, right? And I just choose not to get involved. Because I do have a rather high profile, I've chosen that I'm not going to get involved in these kinds of weird, off-the-wall strategies. Now, the point I'm trying to make, though, is simple. You invest in investments that produce wealth. Usually, those kinds of investments also produce tax deductions. So if you want to get rich, you fight the IRS legal. So you literally go out and say, how can I get out of paying taxes? And whatever you do to get out of paying taxes also causes wealth, and you get rich trying to get out of paying taxes. I know it sounds weird, but I've been out here too long to deny it. I see it happen with family after family, person after person, buying investments that produce tax write-offs that are also growing in value and producing income. If not now, income in the future. All right, let me show you one example of that. We're now going to talk about an angle to real estate. Now, you know sometimes, if you've been to New York to see a Broadway play, sometimes some of the best plays are off-Broadway. Well, sometimes some of the best stock market plays or the best investment plays are off Wall Street. All right, so this is our first one, Section 42, low-income housing credits, is an off-Wall Street type investment. This is investing in real estate. Specifically, you're investing in a program created by Congress. It could end, by the way, and it was on a temporary basis ever since 1986. But with the last go-round in 1993, Section 42 of the Internal Revenue Code, low-income housing credits have been now put on a permanent basis. This whole program is now made on a permanent basis. Because I think a lot of our congressmen were using these kind of losses, these kind of credits to offset paying taxes, right? And when they did away with them, they couldn't get out of paying all their taxes. So as soon as they got up in their high tax brackets, they put this back in. Section 42, and by the way, don't get turned off by the word low income. Let me give you a definition of the word low income. These are low income housing credits. And don't get fooled by all these guys out here trying to get away from the word low income. I've seen newspaper shows, television shows and newspaper articles calling these affordable housing credits. Are they just trying to make it sound better? Everyone, it's low income. That's the word it is, low income housing credit. Now we'll discuss the word credit in just a minute. But the word low income is people who are making 60% or less of the median family income per locale. Now the median family income across the board in America is about $38,000 a year. That means that there's as many people below that amount as there are above that amount. That's the median, not medium, I'm saying median, M-E-D-I-A-N, the median family income. In your neighborhood, it may be $34,000, it may be $39,000. Every locale is different. All right, before we go on, let's discuss the word tax credit. A tax credit. Now, most of you know what this is, but just so that we're all on the same footing, and I am still amazed at how many Americans do not understand what a tax credit is. Usually, people don't know what a tax credit is because they've never had one. They've never gotten involved in one. All right, let's explain this. Let's say that you're making $140,000 a year. $140,000 a year, that's your AGI, your adjusted gross income. The taxes on $140,000 a year are $36,000. So this is actual tax liability that will be on the back of your 1040. Now, if you were to have a $10,000 tax deduction, where would that go? So you owe $36,000 in taxes. If you have a $10,000 tax deduction, does that go against the tax that you owe or against your income? It goes against your income. So now instead of making $140,000, you're making $130,000. In about a 30% tax bracket in that range, you're going to owe now $7,000, right? I'm sorry, you're going to owe $33,000 instead of $36,000. You're going to save $3,000, right, for having a tax deduction. Now, if you were to, however, go out and find an investment where you could get a tax credit, and you had a $10,000 tax credit as compared to a $10,000 tax deduction, where does that go? Does it go against the income or does it go against the taxes that you actually owe? The taxes. So now, in this example, you owed $36,000, so now you owe $26,000, and you actually save in hard dollar, cash in your pocket, tax savings of $10,000. So basically, depending on your tax bracket, but basically, a tax credit is about 3 times better than a tax deduction. So could we and should we just go looking for tax credits? What do you think? Go finding companies, go finding ways of producing tax credits because they go right against the taxes that you owe. Okay, one of the best ways to do that using the law of leverage is to get involved in Section 42 tax credits. All right, so let me tell you how you could do it. If any of you at home want to go out and find, well, let's do it. Let's go a 9-unit apartment building, small little apartment complex. These are tax credits put out by the IRS. Every one of your states gets $1.25 in tax credits per year for every resident. So here in Washington, we have about 8 million people, so we have about $9 million in tax credits available each year. California has about 30 million people, so it has about, what, $36, $37 million in tax credits available each year for us, for investors. Now, it's administered by a state authority. You have to find out who in your state handles the tax credits for that particular state. And then you start having to jump through some hoops. Does everybody understand that when you dance with the IRS, you're dancing with a gorilla? Everybody understand that? Anytime you do with a business with a government agency, you've got all these hoops to jump through, 40 pages of forms to fill out for the simplest of little things, right? So, you go looking for a building. You buy a 9-unit building. I'll represent it that way. And let's say you pay $500,000 for this building. Now, I'm going to put a little side paper on here because I want to take it away, but I need to ask you something. If you have this building and you buy a 9-plex, do you get income from the building? Yes, the rental income. If not now, hopefully in the future, you'll have a positive cash flow. Do you get tax deductions on this building? Now, you can't depreciate the land. So let's say you take out 20% of land, $100,000, depreciate 400,000, right? Divide 400,000 by 27.5, and you get, you know, 8, 9, 10,000 a year. So you get tax deductions And do you get growth? Yes. Hopefully the building is growing in value. Now it's the number 4. I'm going to put that over here now. The number 4 thing that I want to talk about. We'll put it right down here. Okay. And that's tax credits. This building of $500,000, if you get it to qualify through your state for IRS tax credits, and you put low-income housing people in there, X number of people in the building, if it is considered a new building as compared to an old building, so let me give you the definition of new. A new building is a building that has never been lived in before, and or a building where you have done substantial remodeling, say to the tune of $3,000 a unit. Well, how much money, everyone? If you got a 9-plex and $3,000 a unit, how much? $27,000. So if you would do $27,000 of improvements to this building, then it would qualify as a new building, and you would then qualify for a 70% tax credit. I'm saying, everyone, I'm saying, listen up, and just stop your little VCR here, punch it, take this to your CPA, and let them listen to this. Let them watch this. You get a $350,000 tax credit. I'm going to let that sink in for a second. Now, you can't take it all in 1 year. You have to take it over a 10-year period of time, and you take it like by the month that you start, you know, like in July or whatever, so it really could be spread over almost 12 years. You take this and divide it by 10, and you get $35,000 a year in tax credits on this one purchase.
And would you want that in your own personal portfolio or one of the
What do you think, Ellen? Her question is, do you want that in your own personal portfolio or in a corporation? Probably both. Well, you have personal needs too, right? So you may want to wipe out some of your personal taxes this way. But could your corporation, your limited partnership, your second, your third, and your fourth corporation all buy different tax credit investments? Could this one building be owned by 3 of your different corporations? What do you think? Yes, it could be. Right? So that depends on ownership and some other questions too. Now, you get a $35,000 a year tax credit. And all the CPAs that you've got watching this right now are saying, oh no, you can only wipe out part of your income with tax credits. Well, CPAs, listen up. I'm just a cab driver. Don't understand all that you understand. Study. Follow me through on this, everyone, because this $35,000, don't let your CPAs talk you out of this because they're going to say something weird to you. But before I give you that, I want to show you what happens over here. If the building is considered old, which means you didn't done remodeling or it's been lived in for a long time, then you get a 30% tax credit, which in this example would be $150,000. Again, you divide that by 10, and you get $15,000 a year. Now, quick point. If you only have 7, let's say you have 7 renters in there that are considered low income, all these renters right there in those units, then you would get 7/9 of the tax credits available for that year. Y'all catch that? And if the next year you lose one of the tenants, then you only get 6/9 or 2/3 the next year. But let's say the next year you have all 9 units filled up, right, with low income people, then you get 9/9 or 100% of the tax credits available for that year. All right, now let's talk about what the CPA might tell you. Is this good, by the way? With leverage dollars, by the way, what if you paid nothing down for this building? Or even $25,000 or $50,000 down? Would that be a cool deal? So you're getting, and by the way, now are you getting cash flow? Hopefully, yes. You're getting growth, you're getting tax write-offs, and now you're getting what? Number 4 is what? Tax credits. These credits go against the taxes that you owe. Now, those of you watching at home and those of you here in the class, if you've not come through our Wealth Academy and gone through our major tax seminars and our major entity structuring seminars, you need to do so. And I invite you to call the number and call us and talk to our structuring specialists and our entity people and sign up for the Wealth Academy and come to that because we spend a lot more time on that there than I can here. But I want to show you, and I'm going to try to prove a point, that why you need to hang out with a cab driver in your life. Because I tell you what, everyone, you got to make this decision all the time. You're constantly coming up to this fork in the road, and you got to say, now, do I want to follow the advice of my attorney or this cab driver? Do I want to follow the advice of my CPA or this cab driver? You got to make that choice, because I will always be different than those guys. Y'all understand that? They'll say one thing, I'll say another thing, and you're going to have to make that choice. Right? And I'm telling you, you got to make that choice. Here's why. Here's one example. Your CPA knows about this one up here in the corner. I'm going to show you 3 things right now about these tax credits. They'll know about this first one, and they'll tell you about it, and you'll say, oh, this tax credit thing this Cook guy's talking about is not as good as he makes it sound. They don't get it, everyone. They just don't get it. They'll tell you, no, you cannot take that $35,000, right? I really believe, everyone, that we go through life, living our lives by a bunch of half-truths and mistruths. Do we not? Constantly hearing part of the truth. So they talk you out of investing in this because you're only going to get so much in tax credit. Here's what they'll tell you. You can, against your income, you cannot wipe out the taxes on $35,000, you individually. That's what they'll tell you. Because the Section 42 says that you can wipe out the taxes on your top $25,000 of income. So if you're in a 15% tax bracket, well, you can use tax credits about $4,000 or so. The maximum, if you're in a 39.6% tax bracket, would be $9,900. So the most in tax credits that anybody in this country could use in any given year is $9,900. By the way, is that still good? Because that's $9,900 you get to keep. But they'll almost try to talk you out of this form of investment because it's not as good as taking the whole $35,000. We're not done, everyone. If you listen to the average CPA out there, that's exactly what they'll tell you. But they won't tell you about number 2, and they won't tell you about number 3. So let me tell you about number 2. This is all your income. Now I'm going to put up here the word earned income. But when it comes down to your unearned income, well, what could that be? Covered call premiums, dividends, capital gains, right? Rental income, royalty income off of an oil well that you own, et cetera, et cetera, et cetera. All of your unearned income, these Section 42 tax credits can wipe out all the taxes that you owe. But remember we talked yesterday? At first, you have a lot of earned income. Later on, what do you have? You started tracing your wealth. What do you have? A lot of unearned income. Well, a lot of unearned income, right? There you go. But remember that family limited partnership? Paying out the money to the unit holders? That is unearned income. So these tax credits could be used to wipe out all the taxes you owe on all of your unearned income. Now let's go up here to, let's go up here, yes, let's go up here to number 3. Because remember, capital gains will come over to your back of your 1040, and then the tax credits will apply to the tax that are owed on those too. All right, let's go over here to number 3, corporations. In a corporation, you can wipe out all the taxes on your first $50,000 of net profit. All of the taxes can be wiped out by Section 42 tax credits. So answer your question now. What should own this rental property that you have? Corporation, by the way, what if a corporation doesn't have that much need for tax credits? Could 2 corporations own the same building? What do you think, everyone? You see the point? So you could have different kinds of ownership, picking up income here, tax credits here, and then it can wipe out, these tax credits can wipe out 75% of everything over $50,001. 75% of the taxes can be wiped out with tax credits on everything over 50,000 bucks. Substantial, everyone, substantial. Let me give you an example. Let's say that you have a company that grosses $1 million, and you have $700,000 in expenses. You make $300,000 as your net profit. Well, now, and the taxes on that, by the way, at about 30% are $100,000. You could buy enough of these tax credit type investments to wipe out and knock this down to about $20,000. Would that be a nice tax savings, by the way? And hopefully, will these investments that you're buying to wipe out the taxes also be growing in value and producing income for you? You see that? It's all like one big circle again. Okay, one big happy family. Okay, question back here?
Yeah, if your low-income tenants are already participating in some government program.
Yeah, by the way, Section 8 people could qualify your building.
Still could, even though they're participating in something
They're
else.
perfect. They're low-income people. By the way, these programs are really made to mesh together just like that. So you put low-income people like Section 8 people in there. Okay, how many like the Section 42? Problem, as much as you like it, how many of you are now going to go out and buy a 10-plex or a 9-plex? See, most of us sitting here are too busy running our businesses, right, doing other jobs and all that to become landlords of apartment complexes. So let me tell you what I do. I want the benefits of the tax credits, but I don't want all the headaches of management. Is that a fair story? How many agree with that statement? You're just too busy. You want the growth, but you want the income. You want all the stuff, but you don't want what? Renters, the people, the renters, right? So what can you do? Well, let me tell you what I do. I invest in these through a limited partnership. There are 3 of them that I found, but through a limited partnership. So I become one investor. So I'm like 1 out of 400 people. And then I get 1/400th of the tax deductions. I get 1/400th of the growth. I get 1/400th of the income because I put up 1/400th of the money, right? And I also get now 1/400th of the tax credits. Y'all see that? So I do it kind of on a passive basis where I just put up 5 or 10 or 15,000 bucks. Most of them, by the way, are minimum investments of $5,000. Now, these change all the time. And anybody that buys this home study program, any of you watching at home, any of you here, I will try to put a list in. If not, you can call my office and talk to my secretary, and I will give you a listing of the different companies that put these things out. You understand that limited partnerships, they put them together, and then they manage the buildings for 5 or 10 years, and they don't do any more offerings, right? So I try to keep current with a list of these different companies. I don't have them for sale. I get no commissions. I don't want to have anything to do with that. But I'll get you to some people that I know that sell them. For example, Boston Capital, ANR, WNC in California. There's some companies that do these kinds of deals, right? Put them together, and they allow us to get involved as a limited partner, right? The minimum for most of these is $5,000. Equivalent rate of return, by the way, when you take into account income and the tax credits, the rates of return, depending on your tax brackets, are somewhere between 8 and about 20% on an annualized basis, right? Now, the one thing that this doesn't calculate is the growth, because they don't know what the building's going to be 15 or 20 years later when they sell it, right? So we don't know what that's going to be. Should it go up in value? It should. So we don't know what that is going to be when they actually sell the building and I get 1/400th of the capital gain. You know, I don't know exactly what that's going to be yet. But everything else is pretty good. But anyway, you're getting tax credits. Okay, 8 to 20% return on your money, depending on the income that the buildings produce and the tax bracket that you're in. Okay, it's not bad at all. Not bad. A lot of mine I'm hitting 21 and 22% returns. I'd put up there 8 to 20. Some of them are 19 to 21%.
There's some ruling in the IRS that has something to do with active participation.
No, not in these.
Oh, it doesn't?
Not in these at all. That's exactly what these are created to do.
So you can be turned.
Yeah, these are not like other limited partnership things like, you know, cattle breeding and oil, you know, active participation. That has nothing to do with that. These, by the way, our congressman created this for who? For them. This is a congressman type investment, right? So they don't want to do active. They're actively participating in writing bad checks and other things. They're too busy to do this kind of stuff. All right. Yes.
How negotiable is your partnership?
Not very. You mean how negotiable is? I mean, if you want to sell it, they're not too bad. There's a limited market, and the company will help you try to sell it. Okay. By the way, I've been calling the company trying to buy some just like that. Let me tell you what I do, everyone. I'll just tell you another little investment strategy that I learned in my IRA. I wasn't planning on doing this here, but since we're talking about taxes, I'll show you another cute little deal. I got involved in one of those investment programs where they sell you a like units in a partnership that is buying film rights, right? For example, one of the ones I'm investing in owns the overseas rights to Thelma and Louise, right? All the video rights overseas to Thelma and Louise. Can they do that, by the way? So there's a film that plays in America, there's a film that plays overseas, there's the video rights in America, and there's the video rights overseas, right? They sell them off to different companies. Well, this partnership owns the film rights to several different movies like that, and that Thelma and Louise is just one of them. Well, I paid the $2,000. I bought this in my IRA, and sure enough, I paid my $2,000, and every quarter, I get my little $60 check. All right? Well, it wasn't very much money. So I said, that's not very much. I can do better than that. So I called them up and I said, what could I buy this for? I'm sorry, what could I sell this for? And they said, well, you can sell it for $600. What? I just bought this thing 3 months ago. You're telling me now that if I wanted to sell all those units in that partnership, I could sell it for $600? He said, that's right. That's what it's going for. And by the way, if you sell it for $590, you may get it sold because we got like 38 ahead of you at $6,000 or $600. I said, so there's a whole bunch of other people trying to sell them too. You know, like they bought them. They got caught up in all the enthusiasm from the stockbroker the day before April 15th, right? And they bought these, and now they don't want them. He said, that's right. And I said, well, let me ask you something. If I can only sell this thing for $600, can I buy some of these for $600? He said, yeah, you could probably buy some for $550 if you wanted to. I said, all right, give me 3 of them. I want to show you something, everyone. These things are producing, I can't remember, like an 8% return. Wasn't quite $60, an 8% return. Well, at $2,000, 8%, right, is not very much money. But at $600, and if I get 3 of them for the $2,000, now I'm getting a 24% return on my money. Correct? Because I'm not paying $2,000, I'm only paying $600. So let me tell you what I do. Every time I want to get involved in a partnership, instead of getting involved right now at a brand new one, and I find out that a general partner is putting together another deal, I call them up and say, I want to buy partnership units in your old one. They said, well, we're sold out. I said, I know, but you've got to have some people that want out, that want their cash. And they said, sure enough, they do. And originally it was like $10,000. Now as a fire sale, somebody's willing to sell for $8,000. Sometimes, by the way, they go up in value. Sometimes they go down. You just have to play it by ear and see what they're going for. All right. The next one, everyone, is Section 29. I'm in the middle of page 47. Section 29 tax credits. If you go into your information kits and pull out that yellow piece of paper, it should say Williams on it in your information kits, your envelopes that have all the forms. And you'll find Williams in there. Okay, y'all have that? By the way, I need one real fast. Somebody got one for me? Can you guys share? Okay, thanks. Okay, this, everyone, is an actual copy of, it was white, it wasn't yellow. I just did this white, did this yellow so you could find it real fast. This was a white piece of paper that was sent to my corporation for the stock that I bought in a company. This stock is a trust. It trades on the New York Stock Exchange. It is called Williams Coal Seam Royalty Trust. The ticker symbol on this one is WTU. I know of two other companies that do this. One of them is TRU, and the other one is BRU. This is Williams Coal Seam Royalty Trust, Torch Energy Royalty Trust, and Burlington Resources Coal Seam Royalty Trust. Now, let me tell you how these companies work. Do you remember in real estate, when you bought a house, you had to take out the cost of the land, but then you could depreciate the building, right? You could take the building and depreciate it and get a depreciation expense. And you get to write that off, you know, as a residential for 27.5 years straight line, and you get a little bit each year of a deduction. What is the assumption here? The assumption in real estate is that at the end of 27.5 years, your building is supposed to be worth zero. But in real life, what happens? In real life, it appreciates in value, right? All right, now let me tell you what happened, or what has happened. Some companies have gone out, strip mining for coal, oil drilling for oil, have struck it rich, found huge coal reserves or oil reserves. Now, they know that there's so much coal in the ground or so much oil. Can they tell that, by the way, pretty closely now with all kind of sonic blasting and all kinds of sonar and all that? They can find out how much coal is in the ground. Now, they have a huge reserve under the ground. And they got all their little oil wells here, you know, just pumping up and down all day long, and they're digging out all this, or they're pumping out all this oil. Well, they want money. Is this valuable property if they can prove that there's a lot under the ground? Yes or no? It's valuable. So let's say that it's worth $200 million. Boy, would the owners of this property like to get $200 million cash or have the income over the next 20 or 30 years off of the oil wells? What do you think they'd rather have? $200 million cash. So they say, hey, let's form a trust and let's sell off units and let's go to the IRS, see if we can get some tax deductions, some tax credits. Let's form a trust and let's go out and raise $200 million. Let's pay ourselves the $200 million, right? And then we'll give the trust the royalty rights to all the income. And every quarter, you get a check if you bought stock in this company. They listed these on the New York Stock Exchange, and they are actual trusts. You own stock in a trust. And then you not only get income, you get, and by the way, in real estate, it was a depreciation expense. In oil fields and coal mines, it is a depletion allowance. And you get to deduct so much of the cost of your investment over about a 20-year period of time, because the assumption is at the end of 20 years, what's going to be left under the ground? Nothing. It's going to deplete down to nothing, right? So you get to take, so if you pay $20 a share, in theory, at the end of the 20 years, your stock's going to be worth zero, and you depleted it down, and now it's not worth anything. Okay. So I like these companies for the income and for the depletion allowance, but mainly for the tax credits. So this is the 1041, which is a miscellaneous return that you get from miscellaneous income. Okay. Go down about 1/3 of the page on the front page, and you'll see how many shares I own. Now, I own several thousand shares right now, but last year, 1994, how many shares did I own the first quarter of this company? What does it say there, everyone? At 214.94, how many did I own? 0. How many did I own the second quarter? Okay, so I bought some in the second quarter, right? I own 200 shares of this company. How many did I own the third quarter? 200. How many the fourth quarter? So did I buy any more? Now, y'all with me on this? I'm right here in the middle of the page, and you see that I own 200 shares, right here in the middle of the page. Now, this is a 1041. By the way, I got to tell you, I love this company because they are so cool. They took on the 1040. They even took on the back of the 1040, so flip over to the back. They took and miniaturized your tax return forms and put the tax return forms right on the page, and they said, enter this figure here. Put this figure here. Now, most of our CPAs are dumber than a brick, right? And now they don't have to worry about anything because this company is saying, here, CPA, you don't have to figure this thing out. Take the figure off of the front and stick it right here on this form. By the way, is anybody else like that besides me? So they don't have to shop around, figure it out. There it is. I mean, here, CPA, put it there. Here, H&R Block guy, put it here. All right. All right, so let's look at the income here. The gross royalty income, about halfway down the page, see where it says, then you put this on 1040, line 4, part 1 of your Schedule E. All right, gross royalty income. How much is my gross income for this year? $374.78. Are we all together here? I want to make sure you're all with me on this number. Okay, then look at, I have some expenses. The severance tax. By the way, do I have any more income coming in off this deal?
Yeah.
Interest income, how much on these 200 shares? 93 cents. Not very much, but y'all see that? And then it goes down. What is my total net income on this deal? My net cash distributed is how much? So I have, everyone, $330.82. So I have income off of this of let's just round off, $330. All right. If you're in about a 30% tax bracket, how much taxes do you owe on $330? 30% of 330 is about, round off for me, about how much, everyone? About $100. So you will owe, or I owe, taxes now of $100 on this, but now go down a couple more lines. So this is the tax liability. This actual tax that I have to pay on that income. But remember, if you go over to the back of your 1040 and you figure out all the taxes that you owe, after you figure out what you owe, what's the next box of things? Tax credits. Go find it, everyone. I want you to look at the back of this. Look at the back of your 1040. It's real fine printing right there, but you'll see this is the back page of your 1040, and there's your income. See that first whole big box? You calculate how much income that you owe, and then look at the next box. Credits. So after you figure out the taxes that you owe, by the way, what's it in this example? $100, right? We owe $100, and now go down a couple more lines and look at what the tax credits are. So Section 29 energy tax credits. How much, everyone? $305. So now I have $305 in credits. Now, I got a fairly good return throughout the year. Not a great return, but a fairly good, getting that 374 bucks. Now, I was paying $20, $21 a share for this stock. It's dropped down to 16 and 17, back up to 19 and 20, right? And by the way, let me read this. Oh, I put it away now. Okay, here's this one. I've never read this. I didn't read this when it came out. This is last month. This is that one by Smith Barney. Torch Energy Royalty Trust. TRU from second month to third month because of recent strong market performance. The units have appreciated 21.6% since year-end 1994, outperforming the peers group 5.8% average. Talks about all the IPO. Has an internal rate of return. Okay, for the core, okay. A lot of technical stuff here. All right. They are maintaining a 1995 cash distribution estimate of $2.60 per unit and initiating a 1996 cash distribution estimate of $2.25 per unit. So for every share that you own of Torch, and by the way, Torch is right around $17, so $17 is going to produce $2.25 in income. Is that an okay return? Well, is that better than 10%? What do you think, everyone? So you're going to get better than 10%, but the most important thing is this. No matter what the income is, what do you get? The tax credits to offset the taxes you owe on that $2.25. What do you think, everyone? So again, the equivalent rate of return on this is, well, just the income part of it is somewhere between 8 and 12% on these different companies. But when you figure in the tax credits, once again, depending on your tax bracket, it pops up to around 18 to 24% return on your money. Now, that's not great. It's not 18 to 24% a month. Is this an annual return, everyone? This is an annualized return, but is that an okay return? Now, if you learn how to make a whole bunch of money with covered call writing, why not also invest for tax credits? Oh, by the way, what's your rate of return if you do this on margin? Because all these stocks that I know of, now I don't have any of that Burlington Resources, but I have a lot of Williams and a little bit of Torch. I just started buying Torch recently. I like them, everyone, because you can do them all on margin. That's correct. That's correct. Right? And tax credits. Now, that's off the income, all right? And in this example, you have $305 in tax credits, wiping out $100. What do you do with the other $205? Wipe out your other income, right? Because the $100 is not going to be your only taxes that you owe, right? You have other income, so you use these tax credits. How many like this, by the way? It has neat stuff. This is called a Section 29 Energy Credit. Okay, now we need to move on, because I got the chart there on Williams, but we need to move on. Okay, now we're getting close to wrapping up the Wall Street Workshop, Be a few more minutes, and we're going to wrap this up. But there's just a few important things to do here at the very end. I've tried to, over the last couple of days, give a well-balanced approach to investing so that you're not only investing for income, we get some capital gains. Hopefully, we're doing a lot of the investing in an IRA or a pension type account so that you're not paying any taxes. If you are doing it in the name of your corporation or your own personal name, you also invest for tax credits and other tax deductions to offset that, so that you are taking a well-balanced approach and growing in value as your assets are producing income. Where are you going to go? When you go home after this seminar, what are you going to do? So on page 48, we need to make up a portfolio for you. Whether if you're just getting started and you have like $2,000 to $10,000 to get going, you probably want to do 1 or 2 strategies. Where would you put, let's go to A, if you're just getting started, you have $5,000 to invest. Where would you put the bulk of your money after being here? You got to make this up. I can't do this for you. Where would you put the bulk of your money? That's the big box right here. Let me show you. We're talking about this big box right here. Where would you put the bulk of your money? Covered calls? What percentage of your money should you put there? 70%. Okay, so Mark's saying 70. What do the rest of you say? 40? 45? Okay, then what are you going to do with the other money? You got a little bit more money. What are you going to do? Should you do it all in covered calls, or could you diversify a little bit? Rolling stock here? How much? What percentage? See, so whatever you're happy with. Okay, 20, 30% of it in rolling stock? Okay, what's the other box you're going to use? Maybe options. Options on what kind of stocks? Stock splits. Okay, now, could you go down here and say do 40% in covered calls, 40% in rolling stock, and 10% or 20% in options? So you divide up the box the way you want. Now, let's go down to the bottom box, box C. Mine changes quite a bit because every time I have an expiration date and I cash out of a whole bunch of stuff, if the next go-around I find a bunch of companies that I can do covered calls, guess what I do? I buy the stocks and do the covered calls. What happens if that day, if there's a whole bunch of stock splits? That's what happened in the month of June, by the way. All of a sudden there's Intel, Gillette, Pfizer, all these companies doing stock splits. So guess what I did with a lot of the money? Put it into the stock split options, all right? So mine changes quite drastically. But I basically right now, I'll try to give you a pretty good estimation of where I have my money invested. I have, right now, probably about 40% of my money in covered call writing. I have a good, probably 30% right now of my money invested in options. And specifically, almost all of that now, not all of it, but almost all of it, probably 80% of it, is invested in options on companies that are doing stock splits. But I'm going to change a whole bunch more of that tomorrow. Take a whole bunch of my cash right now, I'm going to shove it into some of those companies we talked about here in the last couple sections. All right, the next one, I have still quite a bit in rolling stock, probably a good, 20%. Right, and then the other percentage that I have, this is in rolling stock, and the other percentage I probably have about 5% right now invested in bottom fishing companies, cheap little companies, you know, a bunch of them I wish I could get out of right now. I keep hitting it big, by the way. Usually I can invest in about 10 companies, and if you get one company to hit it big, well, that will make up for all the losses you lose in the other 9. Yeah, because they go up so high in value, it's pretty amazing. And I have about 5% right now invested in bonds. Some convertible bonds, but mainly munis. All right, and then I have about 5% of my money invested in these tax credits. Now, don't get me wrong, this is not all the money that I have invested. I have outside stock market investments where I have a lot of money invested in Section 42. Here I'm talking about Section 29 tax credits. Right? I have a lot of Section 42 invested in Boston Capital and WNC. I have other cash invested there. All right, now, the point is you need to find an investment strategy that works for you. If you'll now turn to page 50. Now, I'm going to try to show you some combination. We've been talking about these for 2 days, so I really don't need to spend a lot of time on this. But this is the blending. This is the weaving. It's what I call stacking. All right, the whole idea behind stacking is this, like a bunch of pancakes. You take one pancake and you stack on top of another pancake and another pancake and another pancake. All right, so let me just do some for you. All right, the first one is that, and you can't do a lot of these because these are usually cheaper stocks, but you have as a base here the whole idea of cash to asset to cash, right? For example, rolling stock. But underlying this whole thing is that you're doing it all on margin. Well, if you're doing those stocks on margin, then could you not do some stocks on margin and write covered calls? Yes. Could you not then also You know, like for example, range riders. If you got a stock that's going up, you do the range riders, and you try to do those on margin, once again, all right? And you do all of these in a pension plan, right? So you're not paying taxes. Now, the only way you can do them in a pension plan and do them on margin, is, as far as I know, is the USA pension plan that we can set up. All right, and by the way, if you do it here at the seminar or at the Wealth Academy or even at the Wall Street workshops that we have around the country, you can get involved with our entity structuring people and set up your entities and get your, your pension plan set up. Or you can call and we can do it over the phone. All right, if you do all this on margin in a account that pays no taxes, and you do all that with borrowed money you got from your mom and dad, is that an ultimate strategy? You see the point? So you take strategy upon strategy upon strategy, and you just mix and match. All right. So what do you guys like best? I want to know this as an instructor here, and all of you can watch and look at the back of their heads as they do this. Of all the strategies we talked about here today, or the last couple of days, which one do you like the best? Okay. How many like covered calls the best, covered options? Okay. How many like rolling stock? Okay. How many of you like, well, what else do you like? Like them all. How many like stock splits? How many like just plain option plays, but then with stock splits, it even makes it more exciting, okay? Now, what are you going to go home and do? Could you get good at 2 or 3 of these, or should you get good at just one? Or could you get good at 2 or 3 of these? What do you think, everyone? Because options are options, right? Once you understand the option market, then you do options on stock splits. By the way, if the stock splits from 30 down to 15, could you also do options on covered calls on the same stock? Do you see the point? See, it all comes together. There's not just one thing isolated away and say, I'm just going to do this one thing. From time to time, by the way, may you get involved in rolling stocks even if you don't try to get involved in rolling stocks. Because it may go from 7 up to 9, you sell it, goes back down to 7. Hey, that's pretty cool, let's do it again, right? So you buy it at 7, it goes up to 9, and then you keep selling $10 calls, but you don't get called out, so you go ahead and sell the stock at 9, right? All on leveraged stock because you were doing it on margin. You see, everyone? Blending, weaving. Right. A major part of the Wall Street Workshop has come to be the Entity Structuring Workshop. It is also taught around the country as a standalone event called the Entity Structuring Workshop, but we included it here because we wanted you to see the different entities and how they work and how they function. There are basically 6 different domestic entities that you need to get a handle on. One of them is a corporation, specifically a Nevada corporation. Another one is a living trust, phenomenal entity for protecting yourself against probate. Another entity is a charitable remainder trust, which I really like. Another one is a pension plan, some type of a Keogh plan or a corporate pension plan. And then there's also the Massachusetts Business Trust for certain people, and also the family limited partnership, which is an awesome entity for those of you that already have existing assets. So you're going to learn all about that here in the Wall Street Workshop, but I wanted to take time right now to introduce you to Cook University. Call this a commercial if you will, but I want you to come. It's a phenomenal event. We have part of Cook University what we call the Wealth Academy, which is a major 3-day entity structuring, entity training course. Let me tell you my dream and what I've worked on even since I was 16 years old. I knew that I was going to be involved with people and with money, and I like teaching. And I've known ever since I was 16 and 17 years old that I was going to be a teacher. I love this field. See, to me it's really simple. You pay for education once, you continually pay for ignorance. So many years ago, I had the idea that I was going to literally change the way adult education is taught in this country, what I call experiential learning and even sequential learning, where people come to an event and they learn step by step, process after process, not only on how to make money, but on how to keep and preserve and protect their wealth. I've learned this from sad experience because I'd built up several $1 million before, lost it all. Big major fiasco back in Detroit, the real estate business turned around, a lot of negative things happened. And I said to myself, if I ever build up a fortune again, I'm going to make sure that I don't do it the way I did it before. You see, I had everything that I owned in my own personal name. Wrong. You should have different entities set up for controlling your different assets. I want you to think about something. There are 3 financial Goliaths out there, 3 things that can come up and bite you in the fanny, 3 things that can cause you and curtail all the money that you're making and cause you to quit and cause you to lose everything. One of them is a lawsuit. A second one is income taxes, and a third one is death taxes. Now, while you think about those 3 things, lawsuits, income taxes, and death taxes, I want to ask you a question. And this is probably a very important question for a lot of you because you probably never thought about these things before. And here it is. If you make all of the money that you're going to make under you, and if all of the assets that you own are held under you, then think about those 3 things now. The lawsuits, the income taxes, the death taxes. Do you then stand pretty vulnerable? Could one lawsuit then wipe out everything? One income tax bracket for everything? You see, the answer to all 3 of these problems is to split up your assets, to make sure that you do not own all of your things in one legal entity. That's why you need a Nevada corporation for certain types of business endeavors, where you need a limited partnership, maybe for rental real estate or for running a business if you're trying to avoid some taxation. You need the living trust, definitely, to avoid probate upon your death, and to also take your things to what is called the stepped-up basis. Now, you're going to learn a little bit about that here in the Entity Structuring Workshop, but let me tell you what we created several years ago. We created Cook University. It really has 5 components. One of the components is what we call the Wealth Academy. It's a major 3-day training seminar. We do most of these in the Northwest because I live in the Northwest. We do them from time to time around the country. It is a 3-day awesome event, and we're going to put the 800 number up on the screen so you can call and get information about Cook University. And by the way, we also have a special for those of you that have purchased this Wall Street Workshop, that part of the money that you paid here could apply towards a tuition for Cook University. The second component is what we call a mentor apprenticeship program, where I and my staff are the mentors, and you become millionaires in the making, if you will. You learn how to make money. And all these seminars that we teach are designed to make money, but also then show people how to keep, preserve, and protect their money. The mentor program is a major seminar, a major course that you can take, and you can call from time to time to me and my key staff. We'll help you structure your affairs. We'll work with your CPAs, we'll work with your local professionals like an attorney or title officers or whatever to help you get the job done. Another major part of Cook University is the entity structuring savings. People that are participants receive all kinds of savings, usually getting back all the cost of tuition. Now, United Support Association, our key company, which is part of Profit Financial, which is a publicly traded company, the United Support Association sets up entities for people. We establish and set up and process pension plans and Nevada corporations and living trusts. We've done literally thousands of these entities for happy customers all around the country. You can also call the same number if you want to learn more about setting up a Nevada corporation or a pension plan. But by the way, if you participate in Cook University, you'll save a lot of money on doing so. Another component of Cook University, because we believe in education and ongoing education, is we sponsor events like the Executive Retreat, which is a 2-day event in Lake Tahoe twice a year, where we get together and actually do a board of directors meeting with you and your family for running your corporation. How would that be? To actually have a seminar, and it's not really even a seminar, it's a workshop where you come and you fill out your minutes. You fill out your articles of incorporation. You sign off your bylaws. You have an annual meeting. You understand how to issue stock, voting stock and non-voting stock, how to fill out the ledgers. That's called the executive retreat. And we have numerous other seminars that you can also participate in. The last component of the Cook University is a major set of home study courses, mostly audio, but some video, and manuals and workbooks and forms and documents to help you implement and put all these things together. It's called the Financial Fortress, and I'd love to have you call and find out about that too. Well, Cook University has been around now for about 4 years, and it's doing very, very well and helping people, again, learn how to make a lot of money and then keep it. Let me just quickly review that. There are 5 components of what we're trying to show you. Number 1 is how to make money, either running your own business, stock market, or real estate. A second component to Cook University is to help you reduce your exposure to risk and liability. The third component is to help you reduce and possibly eliminate income taxes. The fourth is to prepare for a great retirement. And the last one is what we call bequeathment, to make sure that your family, in a tender, loving, caring way, gets everything that you've worked so hard to build up. Well, again, that's Cook University. Call the 800 number on the screen. I'd love to have one of my staff talk to you and see if you need it and want it and are willing to participate in a great course that will be beyond your wildest expectations, give you true value for your money in this educational format to help you make this money and make a lot of money so you can keep it, preserve it, and make sure that your family gets everything. And again, call the 800 number on the screen. Now back to the Wall Street workshop. The entity structuring workshop coming up next will give you a basis to some of these different entities. So let's get back to the seminar right now. This section is about structuring your financial affairs to make sure that you can keep more of the money that you're making. Now, I want to spend some time on this, especially for those of you at home, because a lot of people here in the class have come to our major seminars like our Wealth Academies and our Cook University programs and our executive retreats. And I want to mention several things to all of you, though, that will help you keep more of what you're making, lower your exposure to risk and liability, prepare for a great retirement, and make sure that then, at the end, that your family gets everything that you worked so hard to build up. To start this, you've all heard the term financial planning, have you not? And you'll all have probably heard of estate planning. Well, what I do is what is called entity planning, entity structuring, where we use different entities for setting up and controlling your financial affairs. Let's talk about the problem. One of the problems with living is that things come up, especially as you get to be worth a lot of money. I really believe, everyone, that there are a lot of fallacies of wealth that are being perpetuated out there. For example, a lot of people say to me, oh, if I just had more money, if I just had this big batch of assets, then I could retire, quit my job, and live happily ever after, right? Something like that. What do you think, everyone? Those of you in this room that have a lot of wealth, if you do have a lot of wealth, does it take more time to manage it, take care of it? See, that's that problem. See, there's a problem, not with wealth, but there's a problem with the perception of wealth, that if you have a lot of money, then you don't need to spend very much time managing your money. Those of us that do have a lot of money know that it gets to be very, very tough. For example, I mentioned in one of the sessions at the Wall Street workshop that I was that I'm making less money but more per deal, but I'm making more volume but less per deal because I'm spending less time with the money. As you have more of a net worth, yes, you make more money, but your percentage, right, your rate of return goes a little bit down because it just takes more time and energy to run it. As a matter of fact, right now, I got like 2 stockbrokers. I'm thinking about moving some of my accounts to another one simply because one person has a hard time keeping up with all that I do. Matter of fact, he keeps getting chewed out by his managers. Got to tell you that. He keeps getting chewed out by his manager saying, hey, you're getting too much commission on this Cook guy. You know, you got too much money going here. He goes, yeah, but look at all the money that he's making. For example, when I had the account of Charles Schwab, they called me and they says, Mr. Cook, you get to move all of your money into what we call a Schwab 500. I said, wow, what made me qualify for this? I said, do you realize that in the last 6-7 months, you paid us $7,800 in commissions in 6 months? I told that to my wife. She goes, what? We have paid $7,800 in commission. I said, yeah, but hold it. Now, hold it. We took an account from $30,000 up to $90,000 in the same 6 months. Is that okay now, by the way? Don't mind paying commissions as long as you're making a lot of money, right? And I was doing that with a lot of rolling stocks. So you see the point? So you pay commissions, but you're making a lot of money. Now, again, the point, though, is this, that as you have more wealth, then you need to watch it, preserve it, protect it. Because are there a lot of people out there that want to take it away from you, right? Yeah, I have a friend, by the way, talk about borrowing money. I have a friend that borrowed $8,000 from me for some plastic surgery, and now I can't find him. So anyway, a lot of things could go wrong. There are basically three different financial Goliaths out there. There are three things that can come up and bite you in the fanny. I'm going to make a list of these because these three are very, very important. One thing that can destroy, at least curtail, everything that you're working so hard for is a lawsuit. A second thing that can really eat into your profits and cause you to go slowly is income taxes. And the third thing that can really affect everything you're doing at the end of your life is estate taxes or death taxes. These are the three financial Goliaths. Now, while you have those three, while you see those three things up there on the screen, I want to ask you a question. And this is the most serious question I can ask you in this whole couple days that we have together. First of all, look at those three things. If you make all of the money that you're going to make, if all of your income is made under you, as a husband and wife or as you singly, if all of your income is made under you, and if all of the assets that you own are held under you, do you then stand pretty vulnerable? Could one lawsuit then wipe out everything? One income tax bracket. So see, the answer to all three of these problems is to split up your assets, to make sure that you do not own all of your things in one legal entity, especially in joint tenancy between a husband and wife. Now, I know that we've all been sold that bill of goods for a number of years, but joint tenancy should be outlawed. It is that dangerous, especially between a husband and wife. And I'll prove that point as we go through some of the following. So, in order to solve these problems, and by the way, talk about solving these problems, can I ask you another question? Is there anybody in your life that will work as hard to keep your estate together as you work to build it up? No? So if you want your estate to be taken care of after you're dead and gone, when do you have to take care of it? Now. I mean, the hand does not come very far out of the grave to control anything. So if you want it to be controlled, like your kids get money at such and such a time when they get married or for medical purposes or when they get to be such and such an age or whatever, if you want your church to have money or whatever, then you've got to take care of those affairs before. All right, now I'm going to get into the 6 different domestic entities. We won't have time today to talk about offshore corporations and trusts. I'll just mention those briefly and another place where you may want to put some money. But what I would like to share with you here today is what I have tried to develop and what I've worked so hard for. Under our company, United Support Association, that is an entity structuring company. It also sponsors seminars to introduce to people these different entities and what it's all about. It sponsors Cook University and the Wealth Academy. The parent company, Profit Financial, is also an entity that is acquiring and has acquired companies to process entities, teach seminars, and help people do this. See, everyone, there are 5 legs on my financial table. I don't come into your life and say, I'm just going to show you how to make money and then leave you to the tax collector. Likewise, I don't want to just teach a tax seminar and not show you other ways of making money. So the 5 legs on my table. Number 1 is that I write books and do seminars, and so does the company, on making money. So we show people how to make money. The second thing that we show people how to do is to lower their exposure to risk and liability. The third thing that we do is to show people how to lower, eliminate if possible, but at least to lower or reduce taxes. And that's a big part. I mean, why? Why spend all this time managing your money and give 40% of it to the government? The fourth thing that we show people how to do is to retire rich. How to stock aside money into a retirement account, have that money growing, and we're going to show you some good strategies on that here today, but is on to how to prepare for and live then a great retirement, whether you're 42, 52, or 62. And the fifth thing is what we call bequeathment, which is to make sure that your family gets everything that you're working so hard to build up. All right, now, keeping these 5 topics in mind, I'm going to just share with you some ideas, and we're going to go through some different domestic entities. Now, when I say domestic, I mean United States entities. If you really want to get more sophisticated, then you should have offshore trusts and offshore what are called IBCs, or international business companies. That's an offshore corporation. It's like a streamlined corporation. I want to just give you one example. If you have an offshore entity, you can open up, by the way, you can do it yourself personally. You can have a Swiss bank account, right? You realize that having a Swiss bank account, your money in the United States has gone so far down. I don't remember the exact numbers, but it's something like this. If you had $10,000 in American money 20 years ago, from 0 to 20, your money today, that $10,000 has gone down in value to something like $3,637. If your money was held in a Swiss bank account, your money today would be worth $9,999.40. Why would you ever want to have your money kept here in the United States? held in American dollars. Your American dollars are going down on average 6% a year against the Swiss franc. You want to know why? You know, in the United States, we went off the gold standard, did we not? We've gone on to a total monetary policy. And our currency against others, and the three major currencies in the world are the Swiss franc, the German mark, and the Japanese yen, and the American dollar. Those are the four major currencies. Against each other, our currency has gone down so far. You know, I was in Japan several years ago. Back then, 360 yen, right, could be purchased with $1. Now it's like 85 to 90 yen for $1. It has gone so far down. Now, what has happened? Let's go back to Switzerland. In Switzerland, by their Swiss constitution, the United States has gone off the gold standard, but in Switzerland, they are on a 200% gold standard, which means that they have $200 or 200, you know, for every Swiss franc on the street, they have 2 Swiss francs in gold backing it up. So what's happened to the stability of their currency? It's the most stable currency in the world because it is backed up by gold, and we should be too. By the way, quick point, just because the United States has gone off the gold standard does not mean that you have to go off the gold standard. You can have gold coins like American Eagle coins, you know, all the way from maple leaves to whatever. You can have a certain part of your portfolio in gold. 5%, 10% would not be too bad. By the way, how many wish you had like $50,000 in gold coin stashed somewhere? Anybody here? Be a nice deal, would it not? Would that give you some security? Because if the economy goes up and down, whatever happens, you've got gold, right? And gold is the ultimate hedge against inflation. It doesn't pay dividends, right? You can't do covered calls on it. It doesn't. You can't collect rents on it. It just sits there and keeps pace with, it actually controls inflation to some extent. So having some gold, you know, from an investment point of view, if there's a catastrophe or whatever, it can make a lot of sense. It can do a very, very good job for you. And I don't have that much, but I have about 5% of my assets in gold. All right, now, we're not here to talk about that. We're here to talk about protecting your wealth. That's just one little strategy on protecting against inflation. We're going to talk very quickly now. And this is not, by the way, a full-blown seminar on the different entities. I want to give you a synopsis of the different entities. And those of you taking notes, let's go through these very quickly. There are 6 different domestic entities. 3 of these I would call major entities. 3 of these I would call minor entities. The one major entity that everybody needs is a living trust. All right, so here we go. I'm just going to give you some reasons behind this. A living trust. A living trust is an entity that you create by formulating the documents and signing them. You establish a trust. At the very beginning, you're the trustor. You're putting everything in. You're also the trustee because you're alive. The living trust operates off of your Social Security number while you're alive. The main reason for having a living trust is for avoiding probate. Is the main reason to have one. Now, there are some minor reasons, but the main reason is to avoid probate. And probate should be avoided. The average cost, the average time is horrendous in this country. Has anybody in this room ever been through the probate process with a loved one or a family member, anybody like that? It is a weird, ugly process, is it not? And you don't want to go through probate. So the way you avoid probate is to not die. But if you think you're going to die in the next 300 or 400 years, the next best way to avoid probate is to make sure that when you die as a pauper. Now, don't get me wrong. A lot of you, after coming to the Wall Street workshop, you're going to be worth millions of dollars in a few years. Right? But how do you die as a pauper? Don't make any of this money in your own personal name. Right, let me say this again. You need to cease to exist. There's no more you. When you go to the movies, you're going with living trust money. When you buy groceries, you're buying them with living trust money. Everything you do, you're doing with money that is not yours. You don't have anything. It's what we call control without ownership. You don't need to own anything, but you need to control everything. All right, living trust. The second big reason for a living trust, especially between a husband and wife, is that it takes your assets to what is called the stepped-up basis. Now, I'll just give you the example. If a husband and wife own a house, one of them passes away, the other one wants to sell the house, there's going to be capital gains. Go back again. If they own the house in a living trust and one of them passes away and the other one wants to sell the house, there's no capital gains. Did y'all catch that? A lot of you are worried about capital gains. I just showed you how to get out of that. And not only for your personal residence. Those of you that are married, stocks, bonds, mutual funds, real estate investments, business interests, anything and everything you own between a husband and wife, if it is owned in a living trust, goes to the full stepped-up basis upon the death of one of the spouses. The other spouse, the living spouse, can sell off anything and everything and pay no capital gains at all. That's how good a living trust is, and most people don't even know that. And by the way, these ambulance-chasing attorneys out here that are teaching living trust, and I kind of make fun of these guys, but has anybody noticed that living trust seminars are kind of like a phenomenon of the last 3, 4, 5 years? You didn't see them like 8, 9 years ago. I've been teaching living trust seminars since 1982, And back then in 1982, I was talking about living trust. People, what's a living? Now everybody has heard about them. Most people know about them. But when I started teaching them, nobody knew anything. And I was teaching 10 years ago what these attorneys are out here teaching today. Right? I've got a real head start on them. I've studied everything I can study. I've helped to set up now literally thousands of living trusts for people, to establish them, to get them set up. We have attorneys on staff that help do all this. We have companies that do all this, and we'll establish and set up your living trust. And by the way, there's a great seminar on it right here. Where did it go? There's it right there. I'm sorry. Setting up your living trust. Real close, so I couldn't even see it. All right. The second entity I want to talk about is a corporation. Now, I specifically like Nevada corporations, but more important than just having a Nevada corporation, I like a corporation. Just a simple little family corporation, right? And usually I say family because there's usually only family members involved. I like a corporation for several reasons. Number one, it is the only entity that you'll establish that is perpetual in nature. A living trust has an end. A limited partnership has an end. A pension plan has an end. Everything ends except the corporation. It is the only entity that you can set up today. It could last 200, 300, 400 years. So because it is perpetual in nature, it's probably one of the main reasons for having a corporation. Number two, probably the main reason for having a corporation is because most people set up sole proprietorships to run their businesses. And sole proprietorships are so bad. They're dangerous. Lose your house, lose everything you own. You have no tax planning capabilities or very little. Sole proprietorships are so dangerous, and because of that, I'm going to put up here as number two. Number three, a corporation allows you to protect yourself against liability. You have a tremendous amount of liability protection with a corporation from two sources. One is from the shareholder's point of view, and two is from the officers and the director's point of view. You have liability protection. In effect, you as a shareholder of your little family corporation, you as the officer and director, unless you do something illegal, you are not responsible for the activities of your corporation. It is not you. You've established a new entity. That new entity can have brokerage accounts, it can buy and sell real estate, it can start up businesses. That entity can act for you and go out and become very, very wealthy. Number four, you have a tremendous amount of tax advantages with a corporation. I'm going to make a quick list right now. If you like what I'm showing you right now, by the way, this entity structure, this corporate structuring clinic right here is one of the most phenomenal seminars I've ever done. Probably the best seminar, even out of all these 7 that you see up here, the best thing I've ever done is this corporate structuring clinic. I've taken my old financial savvy tapes and I put it all together in the corporate structuring clinic. Taxes. Number one, you can have your entity, your corporation set up in a different state tax jurisdiction. You can have, with your corporation, you can divide up the stock. By the way, that's a good estate planning tool too also. Number three, and I'll show you how taxes work on that in a little bit. Number three, you can have off year ends. You do not have to have a December 31st year end. You can choose a different year end, and that's a way of moving money from one year to the next. Number four, the corporation can pay for a myriad of things, just all kinds of things that you can pay for, but you cannot deduct, but the corporation can deduct those things. Number five, the corporation qualifies also for Section 179 and also Section 42, which at the Wall Street Workshop we're going to talk about Section 42. Section 179 is asset expensing, which allows you to write off immediately the cost of your equipment. Number six, a corporation can pay the officers and the directors certain fees for traveling and for doing other things for the corporation. All right, now I could go on with the list. Let me just show you a few more things. Just go on. 4, 7. One of the greatest things that the corporation can do is just realize that it has different tax brackets. You'll be a lot better making money in a corporation and paying less taxes than you will be by making the money in your own personal name, right? Number 8, it allows you to use your children, not only as shareholders, but also as employees, and that's another way of moving money down to smaller tax brackets. All right. To move on, there are still some taxes, but they involve estate planning. Number 5, one of the greatest things that a corporation brings to the table is its ability to be one of the greatest estate planning tools ever. For example, you can have different classes of stock. You qualify then for asset freezes and things like that. Number 2, you have different amounts of ownership, different percentages of ownership, which allows you to give certain kinds of stock to your kids. and also then give it in different amounts. You can have, for example, 5% to mom, here's the wife, 5% to dad, and you got 30% to each of your 3 kids. So there's your kids. Now, look at this percentage. Mom and dad, the wife and dad here have 5%, and the 3 kids have 30%. Now, if the company's worth $2 million and mom and dad are to pass away, they only have 5% ownership. And by the way, talk about classes. You can also have voting rights here and non-voting rights there. So you have non-voting stock and voting stock, so mom and dad control everything, but they don't own very much. Now, if mom and dad die, they only have 5% of a $2 million batch of assets, right? It's only $100,000, and that's way under the amount that you have to pay federal estate taxes on. The point is that you can divide up your assets, maintain control, and keep your personal net worth really low. Remember, control without ownership. The last point is this. The corporation is easy to set up, easy to operate, and it is just easily recognizable. Number 6? Number 6. It's recognizable and it's easy to set up, which means that to open up bank accounts, operate on a day-to-day basis, it is easy to do. The reason I bring that up here at the very end is this. The corporation should be the workhorse. It should be the entity that you have that becomes the workhorse of everything that you're trying to work for and to build up. And when in doubt, by the way, sometimes I even come down to whether I should have a corporation or a limited partnership, and I end up flipping a coin. But when in doubt, be a corporation. In other tax situations, it can have an off year end. A limited partnership cannot. So let's talk about limited partnerships very quickly. Okay, the next entity is a limited partnership, and once again, I call it a family limited partnership. A family, usually because only family members are involved. The word limited means limited liability. The unit holders of the partnership have limited liability. All right, number 1, the main reason for doing this is for placing your assets. And I really like limited partnerships for rental real estate. If you have any type of real estate investments, they are perfect in a family partnership. The reason for that is that at the partnership level, there is no tax. If there is money made at this level, all the money is taxed down to the unit holders of the partnership. Number 2, it gives you a very, very good vehicle for tax purposes. Okay, I want to show you this one because this is very important. I'm sure that a lot of people in this audience today and at home, especially if you have your own small business, would like to learn how to not pay Social Security taxes. So let me show you how to do that. And by the way, does anybody want to pay money into Social Security? Our Congress doesn't pay money into Social Security, so why should we? By the way, remember when these, I thought that a bunch of them were conservative, but it doesn't look like they were. They got back there. Remember those guys that went back there in 1995 and said, we're going to go back in and make Congress abide by all the rules that all the rest of Americans have to abide by? Remember that? So they went back there and they got it in. They voted it in, and the president signed it, where they have to abide by the American with Disabilities Act. They have to abide by the Civil Rights Act, right? All the acts that they had exempted themselves from, Congress now has to abide by, except for guess what? Social Security. They have still exempted themselves from Social Security. If our congressmen will not pay money to Social Security, why should we? That makes sense to anybody else here? It is one of the stupidest places you can put your money. If you're 30, 40, 50 years old and you put money into Social Security, as compared to taking that money and sticking into a bank account at 5 and 6%, you will get back about 18 to 20% of what you put in as compared to putting your money into another form of investment and controlling that money yourself. Why would anybody want to put money into Social Security? Here's one of the problems, though. You have a little business. You have a little company making $50,000 a year. All right? One of the problems is when you do your 1040, actually you do your Schedule C, which is your small business profit and loss, and you transfer from your Schedule C over to your 1040, and you owe about $9,000 in taxes. That's a bad problem, is it not? But it also goes from your Schedule C, not just to your 1040, but where? To your Schedule SE. Well, what's that? Your self-employment taxes. And all of a sudden now you've got Social Security taxes, 15.3% of that up to $60,000 or so dollars, which means that you owe now another $7,500. So you've got out of $50,000 of income, and by the way, you're working 10, 12 hours a day running your little company making $50,000 a year, you owe the feds $16,000. Anybody like this or not? Now watch this. I'm going to show you how to drop off this part of it over here. When you set up a limited partnership, you set it up with units. Now it's called stock in a corporation. In a partnership, it is called units, and you will see unit holders. So you'll have a unit holder of a limited partnership. So I'll do it again. this time you have the limited partnership, and it's out doing real estate deals, has a dry cleaning business, a management company, whatever you're doing, and let's say that this company is making not $50,000, let's even say $100,000. All right, in this example, we'll still give the mother and the father, we'll give the mother and the father 5%. Right, and we'll give each of the kids, well, let's say I have the 3 kids again, but let's also give mom and, let's say grandma and grandpa some of the units. So you have kid number 1, kid number 2, and kid number 3. Let's give them each 20% of the units. Let's give grandma and grandpa each 15% of the units, and mom and dad own 5%. Now I want to show you how this works. I know I'm quickly going through this, and if you want a more detailed explanation, it's all here in the Financial Fortress. But I want to give you a quick explanation. You have $100,000 now of income made by this partnership. There is no tax at the partnership level. All of the money is taxed down to the unit holders by the respective share of units. If one unit holder owns 17% of the units, then they have to pay taxes on 17% of the profits, and they get to take 17% of the losses if there are any losses. You see how that works? So there's no tax at the partnership level. This partnership fills out an IRS form 1065 at the end of the year and gives K-1s to its different unit holders. And that's an information statement about what the unit holders have made from the partnership. Now, before I can go on, I need to explain something about kids. One of the greatest plays that we used to have was using our children for making money. We could buy assets right in the name of our kids. But in 1986, they changed all that. And the law then says, from now on, all income made by the children is taxed at the same tax bracket as the parents. And everybody gave up. Right? Everybody gave up. All the tax attorneys, all the CPAs said, well, that was sure a great idea while it lasted, and everybody gave up except for me. You don't give up on good ideas. You just don't. Right? So listen to the law. And some of you will start smiling right away. It says, from now on, all income made by the children is taxed in the same tax bracket as the parents. So what's the new game in town? That's right. Get the parents in a low tax bracket. If you got a little company making $80,000, mom and dad make $20,000, let the kids make $60,000. Right? Now, they talk about this definition of a kid because it kind of changes everything here. When kids are 14 years of age and older, they are in their own tax brackets, no matter what money they make. But if they're 13 years of age and younger, then their money, their income is aggregated with the parents. All right? So let's put one of these kids up here. One of these kids will be, say, 13 years old. 13, and this kid is 16, and this kid is 19. All right, now let's look what happens here. $100,000 of profit from this company. Mom and dad now have to claim $5,000 of that because that represents their 5%. Their daughter, that's 13, have to claim 20% of that, or $20,000. Well, this money's all aggregated together, so this money basically is all taxed at 15%, even on less than the $30,000, because with the standard deductions and all that, you'd have basically income of $20,000 or so to pay taxes on. Now, the daughter here and the son here are over 14, so they have to claim that money. But hey, they're single, and that money, therefore, is taxed at 15% and 15%. Now, I hope that this is important to you, because remember, between $0 and $36,900 of the tax brackets where they are today, that's at 15%, right? And then it goes up to 28% and so on. So some of this money here at the $100,000 is going to be taxed at 15, some at 28, some even at 31 or more, right? So now, look at mom and dad over here, grandma and grandpa. They could have their 15%, their $15,000. Now, some of that may be taxed a little bit higher, but most of that's going to be taxed at 15% also. What I just showed you was a way of taking $100,000 of income and getting it all taxed at 15% or less by setting up a simple little family partnership. Anybody like this? I know I went through that very quickly, but it's just a simple little partnership, and I don't care what kind of business you're in. It's a simple little business to make sure that the money is not taxed at the partnership level, but taxed down to the individual unit holders. And I'm not done. All of the money paid out to these unit holders here on this investment in this partnership, all the money paid out to the unit holders is unearned income, and there are no Social Security taxes on unearned income. Everyone, I've been helping people do this for 9 years. If you set this up and operate this right, you've just dropped out of the Social Security system. There's no taxes on unearned income. Now, don't get me wrong. If mom and dad took, say, $30,000 a year to run the partnership, management fee, would that be earned income now? Yeah, that'd be earned income, and they'd have to pay Social Security taxes on that. But all the money paid out to the unit holders, including mom and dad, is unearned, and there's no Social Security taxes. So there's one fell swoop. And these are great for owning real estate and also for running little high cash flow businesses where you don't want to pay money into Social Security. All right, the next entity, which I'll just mention briefly, is a business trust. if you have, and technically speaking, they're what is called a Massachusetts business trust. Sometimes these are referred to as pure trust or sovereign trust or commonwealth trust. But a Massachusetts business trust, because Massachusetts pioneered this, and by the way, we record them in the state of Nevada. If you use my company to set these up, we record them in the state of Nevada for all the secrecy and protection there. But a Massachusetts business trust can be set up to lease equipment. Now, you buy the equipment in the name of the trust. So whatever equipment your company needs, you buy it there, and then you lease it to your corporation. So you have a corporation here now leasing computers, cars, whatever, from this company over here. And they pay money. They pay a lease payment. Now, this is what we call an equipment leasing operation. Here's the point. If the IRS, or if you get sued and somebody shows up and says, we're going to confiscate all your equipment, now what do you say? I don't own it, I lease it, here's the UCC forms, I pay payments over here. Y'all see that? You set up your own equipment leasing operation, and you've gotten everything out of your name into the name of another entity, that nobody can take away your equipment. By the way, I've seen people do this with rental properties, I've seen people do this with other houses. It's a great strategy for getting things out of one name into the next name. All right, the next entity that we're going to talk about is a pension plan. Now, do not let your CPAs or other people tell you that a Keogh plan is on par with a corporate pension plan. Let me just define those words. They are not. The best pension plan out there is a corporate pension plan. If you are a sole proprietorship, you will set up what is called, if you want to have a qualified pension plan, what is called a Keogh plan. If you're a corporation, you will set up what is called a corporate pension plan. Now, from some angles, they look the same. But when you really get into it, they are not the same. Now, once you decide what entity you are operating under, a sole proprietorship or a corporation, then you really have two choices. And that the one choice is setting up what is called a defined benefit plan, and the other choice is a defined contribution. Because probably 99% of you watching right now need a defined contribution plan, that's what I'm going to spend the time with. Very few people, unless you're older and making really, really good money and have a lot of money to dump aside, then you need a defined benefit plan. For most people watching, and most people in the seminar, they need a defined contribution. Basically, if it's a corporation, you can put from 0 to 25% of your compensation into a pension plan. Okay, but I'll go back to a sole proprietorship for a second. If you're a sole proprietorship, you can put from 0 to 15% into, and it really goes up to 20, but I'm not going to get into all the details of the percentages. The point is this. With either one of these plans, you can put aside up to $30,000 per year per person. By the way, that's $30,000 for the husband and $30,000 for the wife. Now, by the way, is that a heck of a lot more than $2,000 into an IRA? And here's the point. This kind of pension plan is what we call a self-trusteed pension plan. The pension plan is a trust. And in a trust arrangement, there is the trustor, there is the trustee, and there is the beneficiary of the pension plan. In this situation here, you can be all three. You control the money going into the plan, you control the money once it's in the plan, and you control the money coming out of the plan. It's a self-trusteed pension plan where you are in control of this money. Now, let me just give you about 5 highlights of why you need a pension plan. And by the way, this is so important, planning for a great retirement, that I have a whole home study course. I mean, some of these, like for example, the Family Limited Partnership is in the corporate structuring clinic along with the business trust. But the pension plan has its own whole workshop, and so does a living trust. One reason for having a pension plan is that the money going in is tax deductible now. You get to save money now. Write it off, pay no taxes on the money going in. Think about this. You are now investing in different investments with before tax money, not after tax money. Now, you've all heard of tax-free investments, correct? Like a municipal bond or something like that? A municipal bond. How would you like to have an entity, though, that takes all of your investments and makes every one of them into a tax-free investment? What do you think? For example, if you really get good at rolling stock, if you really get good at covered call writing or anything else that we've learned at the Wall Street Workshop, if you get good at this kind of stuff and start making 20 and 30% a month, why would you want to do that in an entity that has to pay taxes? You see the point? So you need to get your pension plan set up, dump in the 10 or 15,000 bucks, and let it go to town. Let it start making the money because it pays no taxes. That's the second point. So the money going in is tax deductible. The second point is the money once inside. All the income made on the money, there is no tax. Number 3, all the capital gains. there is no tax. Number 4, safety. Now, don't get me wrong, you could choose some bad investments in your pension plan, right? But that's not the safety I'm talking about. Let's say that you put aside a bunch of money and your money really grows into a whole bunch and big $200,000, $300,000, $400,000 in a pension account. Could you or could your company go down the tubes in the future? What do you think? Yes? Do you know that nobody could ever go after the money in your pension plan? Only the IRS under certain circumstances and a divorced spouse could ever have access to that money. That $200,000, $300,000 you stocked aside, no liens, no judgments, no creditors, no bankruptcy, nobody's going to be able to touch that money in the pension plan. It's that safe. All right. Number 5. The pension plan has to be, well, I'm going to say liquid. But what I really mean by that is that you're in control. For example, you can borrow money from a pension plan. Now, by the way, this is where Keogh plans and corporate pension plans, go different routes. Everybody says that they're on parity with each other, and that is not true. Listen carefully. If you are a sole proprietorship and you have a Keogh plan, you may not borrow the money from the pension plan. You may not. If you are a corporation and have a corporate pension plan and you want to get a loan for a home or medical purposes, you can borrow money out of a corporate pension plan. You may not do so out of a Keogh plan. All right, the next point. You can have your pension plan set up on margin. Now, this is I'm going to use this point to be in control, but I'm going to put out the word margin here. Now, let me just tell you what this means to me. If you have that $10,000, as we talked in the Wall Street workshop, and you want to buy the $20,000 worth of stock and get all this money going over here, if you have it in an IRA, technically you can do it, but it's almost impossible because of the bookkeeping nightmare that would, follow. If you have your money in a pension plan, now I've got to take a little time out here. I'm trying to tell you the truth, but kind of like it's a half-truth. Pension plans, everyone, will not do margin accounts unless you have it approved by the IRS to be able to trade on margin in your account. United Support Association, the pension plan that we will set up for you, the master prototype plan, has it approved by the IRS to trade on margin. And as far as I know, we're the only company in the whole country that has that approved. Our accounts can trade on margin. Now, is that important to anybody else here? Because now you can get a little bit of money leveraged and doing a whole bunch of good for you. All right. The last point, and we started the whole conversation with this point, with being a self-trustee pension plan, is that you're in control. So if you want to get involved in a variety of different investments, you do so because you're in control. If you want to go do some real estate deals, you do so because you have the checkbook. If you want to open up an account at Charles Schwab, Dean Witter, Merrill Lynch, Smith Barney, wherever, you do so because you're in control. You are the trustee of this pension plan, and nobody, not me, not your CPA, not anybody, should control that money except for you. By the way, is that a little bit scary to a lot of people? Because you know what I just did? By making you the trustor, the trustee, and the beneficiary of the same money, I've just taken away from you every excuse you have for pointing your finger at someone else and blaming someone else for your financial situation, right? I just fully put you in control of your financial destiny. By the way, seriously, is that scary to some people? Because if you don't have anybody to blame, it's like you're half alive. See? You know that like the average pension fund administrators or professionals are getting like 4% returns on their money? Can you guys get better than 4% return on your money just putting your money into a CD? Why? So why would you want to turn your money over to the professionals when you can do such a better job managing the money yourself? So you get in control of your pension account. You get in control of your retirement. The last entity is one of the most exciting entities available today, and it's what is called a CRT, or the one I like is a CRUT, or a Charitable Remainder Unitrust, or Unitrust. All right, I'm just going to show you this very, very briefly. If here's you, are making some pretty good money, say $50,000 a year, and you have a rental house or two, you have some stocks that have grown in value, you can set up a CRUT. One of the neatest things about this trust is that you get to be the trustee of this trust, which means that you control all the investments, the direction of the investments, you get to control everything. You can take now and donate this house into the trust. The trust then could sell the house, raise cash, say $100,000 in cash, and pay no capital gains. By the way, just time out now. I just showed you how to sell real estate without paying any capital gains. Put the house into a trust and let the trust sell the house. You're still the trustee, right? So now instead of you having $100,000, right, and paying taxes on it, the trust now has $100,000. Now this kind of a trust is what is called a split interest trust, which means that at some point down the road, a beneficiary, this is what is called a charity beneficiary. Split interest means that there are two beneficiaries. A charity beneficiary will receive all those assets upon your death. In the meantime, you are what is called the income beneficiary, and you have to pull out a minimum of 5% of the assets every year. Now, you can put, though, into the trust documents certain wording, what is called a make-up provision, that allows you to not have to take out the principal. You can let the money sit there and grow and accumulate and really grow into something powerful, $200,000, $300,000, $400,000, $500,000. And then, by the way, when you turn 65, you could get all those kinds of investments to produce income, buy stocks that have dividends, other investments that have interest income, and have the money paid out upon your retirement. So here's the point. Number one, you have gotten things out of your estate. Is that important to anybody else here? Because if they're in your estate, you're going to pay some heavy-duty estate taxes. Number two, you get some immediate tax write-offs. See, when you donate whatever you donated into the trust, you can deduct up to 1/2 of your income every year until you use up the whole value of the donation. Let me tell you again what I just said. If you're making $50,000, you could donate $25,000, or you could donate the whole $100,000 property, but write off $25,000 of your income this year, half of your income. If you're making $180,000, you could wipe out $90,000 of your income. By having a CRT, you can wipe out half of your income every year by donating these different investments in there. Okay, the next point. The trust can even buy life insurance on your life, usually by setting up an irrevocable life insurance trust, and the premiums paid out, which you would have to claim, then could buy life insurance so that your kids could get a whole bunch of cash at the end of your life. All right. And the main point for doing this whole thing, hopefully, was that you want to benefit some charity or your church, right? And that's the whole main reason for doing this in the first place. So you've got immediate tax deductions, you've got things out of your name, you get to control the income now or in the future, and your charity is going to get the things down the road for a church. It just doesn't get much more exciting than this. This is called the CRT. Now, I don't have time to do it here today, but I do want to show you what we do. We do, with all these different entities, what is called entity integration. For example, I'll show you where I was as of a couple years ago. Everybody needs a living trust. So the parent entity, if you will, let me use that word, the overall entity, the umbrella entity is a living trust. We design a living trust with a dotted line signifying that it is a trust. For most people that we design at our company, and I hope you come to one of our Cook Universities or Wealth Academies so that you can get this information in detail for you. For example, you put your own personal residence here in the living trust, and all your personal things will be assigned to the living trust. If you have that business trust, that would be outside here. We do that as a circle. If you have a corporation, which I really like everybody having at least 2 corporations, because then you can move money from one to the other. You got liability, even lessen further your exposure. You have a management company that kind of handles all of your affairs. This is the one that you live off of. This is the one that you take your money home from. You have another corporation that runs a different business that you have. Let's say that you have some rental real estate. Those go into limited partnerships. So you have a limited partnerships that have your rental properties. Now, and let's say that you start up another business with one of your kids, and that's another corporation. That would go here. Now, it is not that a living trust owns a corporation. It is that the living trust owns the little 5% of the stock that you own in your corporation. Management would flow this way. This management company can help and run or consult with these 2 companies. The management company can also be the general partner to these limited partnerships. If you set up a pension plan, it goes outside here. So this is your pension account. And by the way, look at this. Do you see the pension trust? This is a trust, the business trust. We do not put a trust within a trust. If you choose to have a CRT, we do that as a parallelogram. This is our design. That also goes outside of the trust because a trust does not go within a trust. Now, look at this. Look at this. If I live, and by the way, this is the one that dumps the money into retirement. If I live, am I better off for my retirement? Yes, because I got a flow of money from one year to the next protecting my money, and the money dumps into a pension plan, and this is where you get wealthy, is down here. If I get sued, somebody comes into my printing company or whatever, and I get sued, am I protected? Because where does the lawsuit stop? Right with this entity right here, and it doesn't come in effect. It doesn't contaminate all the other things going on in your entities. Do I have different tax brackets by having numerous entities like this? Yes. And so I can get everything down in 0 or 15% tax brackets. If I die, is my family protected? Yes. Not only because of the living trust, but because of how we own the stock, the voting stock and the non-voting stock, and the percentages that we own. So find a flaw. Find something in this. Now, by the way, you just saw very quickly what we call an entity structure or an entity design. Pretty much everybody comes out looking differently because they all have different groupings of assets, different businesses. But the point is that if you understand the tools in your financial tool chest, you can do a lot of good to protect your wealth. Remember the 5 points. Make money, lower your exposure to risk and liability, reduce taxes, prepare for a great retirement, and make sure your family gets everything at the end. Those are the 5 points that we're trying to cover here. So let me, if I can, just do a little commercial here at the very end of this. Let me tell you what I've designed in the set of books over here that we've sold nationwide for $1,295 called The Financial Fortress. We're going to do a little bit better on that, and I'm going to ask anybody that's watching right now at home to call the 800 number that you see on the screen and just ask what the Financial Fortress is going for. When I say it's a little bit better than that, we've put together a package deal where we have what we call a Level B consultation package that you'll get with this. Now, we charge for that, but we have it as a package deal so that if you don't understand something on one of the tapes, if you're going through the books, then you can call and get information that's relative to you. All right, let me just go through what this is. This, everyone, is setting up a living trust. By the way, this is 6 cassettes, but 2 of these cassettes are exactly the same, and they're designed for you to give your mom and your dad and your grandma and your grandpa. And it's like a synopsis tape, so that there's like a 45-minute cassette of the whole, it's about a 2/3 of a day seminar on living trust. It's called Setting Up Your Living Trust. And by the way, all the workbooks, all the forms, all the documents for doing so are in this documents kit. Now, this kit is just jam-packed. The first book in here is what is called Brilliant Deductions, and the second session in here is a whole set of prototype legal documents that you can just take and lay on a copy sheet and make copies of these if you choose. Let me tell you what you get if you buy my home study course with the package. You get what is called a limited use license. Y'all figure out what that means? Limited use license. You don't have any rights to make copies of my documents and sell them to someone else, but you do have rights to make copies of all my documents for your own transactions, for your own deals. If you want to see a prototype limited partnership, it's in here. You want to see a prototype Massachusetts business trust, it's in here. And you can just fill in the blanks, or you can use our company to set one up, either way that you want to go. But the prototype documents are in the documents. You get hundreds and hundreds of pages of prototype documents. This is called the Wade Cook Amazing Money Multiplier Series. There are 29 different money strategies that are included in this little tape set right here. All right, the next one is the Pension Power Workshop. Again, this is another like all-day seminar on setting up your pension plan. This one right here is a tax structuring clinic, a rather short seminar, but very, very pertinent, useful, functional information on structuring your financial affairs. This is a major seminar that I did on offshore tax havens and offshore corporations. And again, the book that goes along with this is in the back of the documents kit that has you go flow right through with me and to see all these different entities and how it works on an offshore basis. The next one, and this again is my pride and joy. This is the best thing, the best tapes that I've done. It's 6 cassettes, and all the workbooks again are in there, called the Corporate Structuring Clinic. It also has in here the limited partnership and the business trust. All that information is in this tape set. All right, and then I did a video, a lot more extensive than what I did here today. This is about 1.5 hours long, an entity integration video, which shows you, I take what I showed you here today in case study after case study of people that are worth this, and I went through this. And I sat here, by the way, in the same studio, and actually a different studio here, but in the same building, and with a camera, and I designed people, and it's called the Entity Structuring Video, or Entity Integration Video. And again, the documents kit that goes with it, plus you have one more book that's called the Incorporation Handbook. Now again, we've sold this nationwide for $1,295, this whole set with the consultation package. It's a little bit more, but we do have specials on it from time to time. So those of you here in the class and those of you at home, if you want to call the 800 number on the screen and find out what the current pricing is, I invite you to do so.